Hello, everyone, and welcome to the fifth and final day of Emerge Live. I'm Laura Barger, Chief Marketing Officer at the Financial Health Network. Thank you so much for joining us today. If you've been with us throughout the week, you'll know that we've spent our days with some of the best, brightest, and most passionate minds discussing financial health topics, ranging from the future of the workplace to how we help stabilize communities and innovate to improve the resilience of our most vulnerable populations. If you're like me, you've been inspired by the leadership and the commitment displayed by some of our most important leaders across industries and are entering today feeling really hopeful about the opportunities we all have to build a truly integrated financial health system. Which leads us perfectly into today. Our final theme for this week is looking ahead, an integrated financial health system for all. And we have pulled together a powerful group of sessions featuring some of our most critical thinkers across financial services, technology, and policy sectors to discuss what the future holds for financial health and how working together on some of the biggest financial health challenges facing our communities is the next step in making the impact that we all need to see. We're particularly honored to have the OCC's Acting Comptroller of the Currency, Brian Brooks, and Yelena McWilliams, Chairman of the FDIC, here today to talk about the critical role of regulation in the future of financial health. We'll also end the day with a keynote from our CEO and President, Jennifer Tescher. You won't want to miss it. Before we begin, I'd like to just remind folks of a few basic housekeeping tips and items. If you're watching today's live stream from the Emerge Live site, please take a moment to check out the related content on the page. It will not only give you some additional context to the topics that we're discussing today and a way to follow up for more information, but we have also recorded all sessions from the week and they're available to view online. We've included a chat function that will be enabled throughout the day. You can see the chat box right here on the Emerge Live page. Feel free to engage in discussion and ask questions throughout the day. Please note that while some sessions may be able to address questions directly, others may not. We'll do our best to answer what we can. Closed captioning is available throughout the week, and it's been provided by the World Institute on Disability. Please see the link above the schedule to access this feature. If you're joining us today from one of a Financial Health Network member organizations, we'll be hosting our last exclusive networking opportunity at the end of our programming today. To register for the session, please click on the Backstage Access link at the bottom of the page to sign up. And finally, please let us know what you think. We'll find a link to our daily survey just above the schedule on our page. Your feedback will help us continue to deliver a great content experience to all of you. I cannot possibly thank our sponsors enough who really stepped up to support these critical conversations while we work to design a new virtual platform. Their trust in us and their commitment to financial health has been truly inspiring. Thank you to our diamond sponsors, JPMorgan Chase and Prudential Financial, our financial health sponsor, the MetLife Foundation, our gold sponsors, AARP Foundation, BlackRock, PayPal, and Wells Fargo, our silver sponsors, Bank of America, Intuit, and Fifth Third Bank, our bronze sponsors, Capital One, Marcus by Goldman Sachs, Members Development Company, the National Credit Union Foundation, and Opportune. And now we begin with a keynote address from best-selling author and founder of MoveIn, Brett King, on the new normal for the economy coming out of the COVID-19 crisis. I hope you enjoy the day.
The world has obviously changed as a result of coronavirus. The challenges we face today may not be the challenges we face tomorrow. In fact, some of the changes that coronavirus will bring to society may not be understood for some years. Certainly the economic effects of coronavirus may stay with us long after a vaccine is ready and we've stopped the pandemic from doing further harm to society from a health perspective. But when we want to try and get a frame of reference for how this might change our existence, or how other crises might change our existence, we do have some historical analogies to look at. The first example of that, of course, is the Black Plague. It wrought havoc on the communities of Europe in the Middle Ages with, in some estimates, reduction of population in some cities by more than half of the population. But it changed society's structure pretty radically. Most of the wealthy, of course, lived in cities and so were exposed to greater risk. Sanitation was poor at that time, and so the Black Plague, the virus associated with it, spread throughout those communities rapidly. People living on farms, labourers outside of the city, fared a little better. So after the dust settled from the Black Plague, many of those labourers were able to move into city accommodations. Labour rates went up. It was a real levelling of society. Now, prior to this was a feudal system in the Middle Ages in Europe, in particular. There was a great disparity between the rich and the poor. And so the plague was somewhat of an equalizer in this respect. Salaries or wages for labourers went up, and those changes became long-term changes from a societal structure. One of the ironic side effects of this was that the labourers who now had more wealth started to buy new clothes and new possessions. And so the rich, wealthy elite in Europe at the time put in place sumptuary laws. These sumptuary laws were meant to indicate that you kept your social standing. So overt shows of wealth with your clothing was illegal if you weren't part of the rich elite class. So some pretty radical changes. We remember the Black Plague today through social memory. Nursery rhymes like ring-a-rosy, a pocket full of posies, and other stories we have throughout that we remember from these times. When you sneeze and someone says, "Bless you," this is some social muscle memory from the pandemic of the Black Plague. When the Spanish flu hit the world in 1918 and 1919, it devastated, again, societies as a result of this pandemic. Coming out of the Spanish flu, major changes occurred to the US healthcare system. So the big changes that occurred, the most notable change, was the creation of a national health scheme and national hospitals being funded publicly for the first time. Prior to the Spanish flu, public hospitals that existed were mainly for hospice care, palliative care, for those with terminal illness or long-term illnesses. For most people, if they had surgery requirements or they were sick, they would get that catered for within the community by a doctor who also doubled as a surgeon. This organised healthcare system that emerged out of the Spanish flu, the modern healthcare system we see today, was as a result of the devastating effects of the Spanish flu. So are we going to see more healthcare changes as a result of COVID-19? Undoubtedly. There's behavioural changes that we're already seeing. We're seeing people use cash to buy goods and services a lot less. We see physical interactions in stores threatened by these changes. We see JCPenney filing for bankruptcy and other companies under pressure as a result of changing behaviour. Whether these changes become permanent is a question, but certainly for many people, their use of the online world, purchasing groceries, ordering food from restaurants, for many people, the first time they used these technologies was during the coronavirus. And so we've seen an online boom in sales of things online. Amazon's results for the first quarter were up 26% year on year, their highest growth quarter ever in the last few years. And undoubtedly, during the second quarter, we're going to see further increases there. Players in China like Dingdong Maicai saw a 500% increase in their online grocery business as a result of coronavirus. But there's some changes that we wouldn't have expected would have got past the starters block that have come out as a result of coronavirus. For example, we know Andrew Yang, who was running for the running in the presidential primaries, for the Democratic primaries rather. He was proposing a universal basic income model. He called it the freedom dividend. And while that didn't get him selected as the candidate for the Democrats, certainly we have seen the dismissal of UBI as a potential mechanism for the economy weakened as a result of the coronavirus. More people are willing to consider such things. You know, the surplus payments that we had, that the US government levied, this would have been considered unthinkable back in 2019, just a few months earlier. Spain has announced that they will permanently move to a universal basic income model. Now, as we go to air, we're coming off the back of these extended protests around the Black Lives Matter, the death of George Floyd, and so forth that have occurred in history, in society during this time. Now, while these protests and the riots and curfews that resulted in the United States seem like they're happening with an intensity that is unusual, the reality is the data shows us that for some years now, certainly since the 1980s, we've seen a gradual increase in the level and intensity of protests globally. This sort of signals the fact that from a broad societal perspective, people have not been happy, whether it's the protests of the Arab Spring, the Occupy movement, protests against Trump's election when he was elected, and the Black Lives Matter, climate change protests, all of these things. We've seen this sort of intensity rising around these protests. You can see from this illustration of this GIF how the intensity of these protests have been global as well. They haven't been limited to certain democracies. So why is it that we see this increase in protests around the world at a time when you'd think people would be hiding in their homes as a result of fears around coronavirus? Why has that fear, other fear have prompted them to get out and protest amidst this pandemic? Well, the biggest underlying issue that is generating this activity from a global perspective over this multi-decade change is systemic inequality. We see in the United States, we have the highest levels of inequality ever recorded throughout history. Depending on which rankings you use, the US is either 93rd or 125th in terms of income equality in the global scheme of things. So this is creating obvious pressure on the system. This level of inequality doesn't go unnoticed. In historical terms, when we look at what others have had to say about this, these levels of inequality we see generally result in some sort of large-scale systemic change on the political sphere. Socio-economic changes and so forth wrought by policy changes or even revolution. Now, when we look at this underlying inequality, how is that and how is coronavirus going to accentuate those issues moving forward? Well, one of the biggest issues facing the United States is homelessness. When you look around the US today, on a 40-hour working week on minimum wage, a family cannot afford a two-bedroom home anywhere in the United States. The other obvious impact is the healthcare system. Now, obviously in the United States, there's a lot of debate about the healthcare system, but this underlying inequality we have, it really accentuates the problem of access to healthcare. So 2/3 of all bankruptcies in the United States, it's estimated, are result, in part at least, from medical expenses. The cost of healthcare on an inflation-adjusted basis since the 1970s has gone up for individuals up by more than 720%. And from a GDP perspective, it's gone up from 2% of GDP in the 1980s to today 10% of GDP. So rising healthcare costs are a systemic problem that we haven't yet solved. Certainly, universal healthcare, access to healthcare for all, is something that still evades the United States. So looking at all of these factors and looking at the fact that within just 21 days, the US economy was in freefall. We had massive collapse of the stock market, the greatest since the Depression, and the longest run and the steepest growth in unemployment since the Depression. In fact, in many measures, much worse. We'd never had prior to coronavirus where we'd lost more than 1 million people out of the labour market in a single week. But that milestone was met early in coronavirus, and in fact, it peaked at over 2 million people a week being left out of the job market. Now, this has resulted in 40 million people being unemployed in the United States, near 20% of the US population unemployed right now. So this inequality we see is also clear when we look at the impact on various communities in the United States. It's clear that capitalism really didn't have the mechanisms to be able to sustain itself through this crisis. While the market is up again at the moment, this disconnect or decoupling from the actual economy shows that we've really got to rethink how capitalism works for the benefit of those in society. Certainly with problem issues like healthcare issues and access to education, access to housing, core basic needs of the citizenry, then capitalism isn't doing its job when faced with a crisis like coronavirus. Now, historically, when we look at how these changes have occurred and how society has handled these changes, we see that various models of political and socio-economic organisation have fared better than others in different respects. But throughout the vast majority of history, when you look back through, for example, Lessons of History from Will Durant, we see that the vast majority of the time, humans lived under a type of feudal system where the rich elite controlled the assets and wealth of the economy. For roughly 90% of human history, that's been the case. And so this is what we call a pyramid-shaped economy, with the wealth flowing uphill to the 1%. These systems have dominated socio-economic organisation over history. But actually, the most productive economies throughout history are those that Will Durant classified as having a diamond shape. So this is with a very strong, robust middle class, very good income equality and wealth distribution. These economies, such as the post-Second World War economy of the United States, have been vastly more successful from a perspective of economic growth, innovation, and happiness, and meeting the needs of citizens than those economies we saw in the past that weren't geared towards that more on that pyramid-shaped model. So when we look at the effects of coronavirus, one of the key issues is the fact that it produced massive long-term economic uncertainty. Some would argue that even the populist movement and the rise of characters like Trump and Bolsonaro and Boris Johnson and so forth were really due to this underlying economic uncertainty. People were concerned about their future, concerned about access to employment, concerned that immigrants were taking their jobs. This economic uncertainty is set, unfortunately, to continue. Now, coronavirus has given us a glimpse of what life might be like over the next 50 years as we deal with subsequent crises that will affect us economically and accentuate the issues of inequality. So while we have pandemic today, there are other possible pandemics that might emerge in the future that will have a similar effect to coronavirus. But the displacement of workers in the labour force by artificial intelligence or technology-based unemployment is probably the next big crisis and potentially has more economic impact than coronavirus has had. And then, of course, let's not forget climate change. The impact of climate change on society threatens even greater disruption to society. So the fact is, if it wasn't coronavirus, something else would have identified that the system we have, the system based around the current model of capitalism and the current organizing principles of society, are basically not shockproof for these type of crises. So let's look at those two emerging threats to economic order, namely artificial intelligence and climate change. When we talk about artificial intelligence, obviously this is going to provide a massive boom to the economy, particularly in the tech sector. But what we've noticed throughout the coronavirus is it's become clear that the tech giants that have led the growth in the stock market over the last decade or so, these companies aren't necessarily geared towards social goals. They're geared towards commercial goals, like much of the rest of the market. But if we allow AI to disrupt employment without having a social conscience, then in the United States, for example, up to half of the jobs that we have in the US today could be affected or displaced by artificial intelligence. Now, there's a very simple reason why that is and why AI represents a significant structural change that we have to plan for, that we can't just leave to chance or hope that it's not as impactful on jobs as we may have first thought. When we look at Economics 101, one of the key principles in Adam Smith economics, Keynesian economics, over the past 100 years or more, has been that when demand increases, this necessitates an increase of supply, serviced by increased participation in the labour market. So we've always understood that as economic activity picks up, then more jobs will be created. So right now, we hear a lot of debate about how quickly jobs are going to recover as a result of economic activity in the United States, for example. The real core problem with artificial intelligence is it decouples supply from the labour market. So if you have high levels of automation in society, you don't need a lot of human workers to be able to meet the demand. Demand can be met by autonomous algorithms. It can be met by robots. It can be met by automated factories that aren't necessarily required to have human workers in the fray. This is a major restructuring of the way we think about the economy. And unless we deal with this, this will result in a permanent shift to the pyramid-shaped economies where inequality is a feature of that disparity. The other obvious angle is, and we've seen this debate occurring through coronavirus times as well, is that education that we have today, the education system, is not a good fit for this future. So we see a lot of uncertainty around the sort of education that we need to give our children to make them future-proof for these changes in society. Working with robots, working with AIs, these types of issues are clear, but we can't be training them for the sort of jobs that AI is going to take. We need to create new opportunities for employment, think about new job opportunities. Now, let's get to the bigger problem, climate change. Within the next 30 to 50 years, we're going to see major impact of climate change on the entire world. This is not going to just affect one economy, it's going to affect the global economy. Unless we start mitigating that risk, unless we start planning for those disruptions brought about by climate change, the impact could be even more severe than artificial intelligence. And don't forget that the impact of AI on society economically could be even more disruptive than what we've seen with coronavirus. So this cycle of crises will continue unless we figure out a better way to do this. What are some of the immediate effects that climate change could have on the economy? Well, the first is coastal sea rise. We know that about 300 million people could be displaced by coastal sea rise over the next 30 years. That's a big change, but we'll start to see the effects of that already in the next decade or so. The concern about coronavirus obviously is warranted, but we're going to see potentially new pandemics coming out of glacial melts and permafrost as a result of global warming as well. So more ancient viruses could be exposed to the world, creating similar pandemics to what we've seen with coronavirus. So we need to now start preparing our pandemic response much better than we had, obviously, during the times of coronavirus. The potential for food insecurity is also high. We have whole regions of the planet right now that are farming regions that are going to be under stress as a result of climate change and temperature increases. Now, while some argue that it's going to be okay because these farming bands, these areas of land that are used to farm, will just shift to a new location where the farming can continue, you still have a massive shift as a result of supply chain changes. You still have people who are in those old farming areas where the crops can no longer grow, really at risk of economic displacement there. So any effect of this on farming is going to be severe. Even it's expected 90% of crops in the Bordeaux region of France that produce wine could be failures over the next 5 years as a result of these small temperature changes we've seen as a result of global warming. So food insecurity is going to be a big issue. We're going to have to really rethink our approach to farming. The other aspect, of course, of inundating coastal cities and low-lying countries like Bangladesh, as an example, with rising sea levels, is that these continuous flooding systems will create mass migration of affected communities. So, if you think the immigration trend from Syria as a result of the civil war there is an issue, think about that happening on a global basis with 300 million people displaced. It's going to have to change the way we think. It's going to have to change the organizing principles of society. So at the heart of it, we now need to think about capitalism that's reformed. Capitalism with a social conscience. Capitalism that can work to absorb these shocks in the system rather than accentuate them like the US economy did during coronavirus. So how might we go about rethinking capitalism for this new world with these constant potential crises? Well, one good illustration is how we would design society from scratch using a first principles approach to the economy. If we are successful at putting humans on Mars over the next decade or two, setting up the first city on Mars, as Elon Musk wants to do, what sort of organizing principles would we have for that society? Various science fiction writers and futurists have written about this possibility. And one of the really interesting models emerged from a trilogy written by an author called Kim Stanley Robinson on the colonization of Mars. Red Mars, Green Mars, Blue Mars was the trilogy of books. But in that, he proposed that the sole goal of the economy on Mars was to be prosperous, to be sustainable, to be independent of the Earth for supplying them with their needs. So what sort of society would build around that organizing principle of sustainable prosperity? Well, it turned out that you'd have to have a very different view of money. Money became unimportant. When your core needs, getting access to food, water and air, were your core needs, currency was an afterthought in this respect. And so out of this became an organizing principle in this sci-fi world where people had this approach of what he called eco-poetic cooperation. So to build sustainable prosperity, you need to have a view of putting more back into the system than you take out of it. So people were seen as wealthy if they could generate more energy into the system, put more resources back into the system than those who were a drain on the system, taking more resources out. And this is a very different, this is obviously a very different viewpoint from the type of economics we have today. But we do have some great news. Technology is really at the heart of the solution. We have the ability to produce very cheap energy. Solar is far cheaper than we anticipated just a few years ago. And as we increase storage, cheap energy is going to be a feature of this new system. We can use that to create a better environment for us and increase wealth. Homelessness, well, we can now 3D print a home for around $3,000 in 24 hours. So all we really need today is the organizing will, that social conscience, to be able to prevent homelessness in society. We have a whole range of new technologies that are going to help us from a healthcare perspective, whether it's gene therapy, changing our genome to eradicate certain diseases, whether it's rapid production of vaccines and testing, or real-time sensors that we wear on our body or even ingest to be able to monitor our healthcare. The future of healthcare becomes real-time, one of prevention rather than treating symptoms. Food supply. We have a range of technologies now that we can lever, such as robotics and so forth, that make farming much more efficient and predictable. But we're even moving farms into cities, using vertical farms and so forth like that to solve some of the supply chain problems with food that we've had on a historical basis. And we're changing the way we think about food. So we're now producing meat in a lab. Before long, the cost of this meat will, in factory production terms, will be much lower than meat farmed on the out in the fields. So this is a radical shift, but it changes supply chain. It changes the way we think about this. We've seen a real shift around education during coronavirus. Schooling from home, working from home, these behaviours are likely to become more permanent as we see that there's not a real benefit in having people gather in office spaces or schools. While this will have obviously an effect on commercial real estate, it's also going to impact the way we think about education. The good news out of this is we can have very high quality education provided to students just through access to the internet. So basic digital access is key. So where do we land with all of this? Well, we see 4 potential futures that could occur based on inclusionary policies or exclusionary policies, and sort of a dystopian future versus a utopian future. Most likely, we're going to play between these 2 models that Will Durant talked about, the pyramid model and the diamond-shaped model, with potentially neo-feudalism, where the rich have access to all the best technologies, longevity treatments and the best healthcare, and so forth, where the poor are excluded from that. But a better system, of course, is an inclusive system that uses technology to solve those problems of inequity. So we call this techno-socialism. So to wrap it up, why techno-socialism? Well, we need capitalism with a conscience. That's fairly clear. But technology can be deployed, if we have capitalism with a conscience, technology can be deployed to fix some of the most intractable problems humanity faces. The coronavirus is not the last crisis we're going to face that's going to radically change the way we think about economics and organising principles around society. The wave of artificial intelligence and technology based on employment and climate change, those are potentially worse in terms of scale of economic disruption than what we've seen with coronavirus. So if we don't start reorganising around this, then we risk the future. The main thing to understand here is that if we want a utopian, inclusive future, we want a positive future, then it's not going to be left to free market to come up with that result. We must plan and commit to that future as a society as a whole. And that's what we call techno-socialism. Thank you.
Hi, I'm Jennifer Tescher, founder and CEO of the Financial Health Network. And I'm thrilled to be here today with Yelena McWilliams, the chairman of the FDIC, and Brian Brooks, the acting comptroller of the currency at the OCC. Welcome to both of you.
Thank you. Thank you for having us.
There's no shortage of topics for us to talk about. So I'm going to get right into it. The 1-2 punch of the pandemic and the resulting financial fallout has created significant uncertainty about the overall health of the economy, especially since we just don't have a good sense yet of how long it will take us to quote, get back to quote unquote normal, whatever that means. We're officially in a recession. And when the pandemic first hit, we saw a lot of banks halt garnishments and grant customers loan forbearance and fee waivers. Many of those are now set to expire in the summer and fall, at the same time that the extra $600 unemployment payments are also at the moment slated to come to an end. Also, a lot of moratoriums that had been placed on evictions are also scheduled to come to an end. So this really is creating a perfect storm for certainly for consumers and potentially for the banks that serve them. So I'm wondering, how are you advising the banks that you supervise about what they can and should be doing to accommodate their customers? And for how long can they actually continue to grant these kinds of waivers and forbearance? Yelena, why don't we start with you?
Sure, happy to. So it was important to us at the FDIC as soon as we started having the sense of how big the pandemic is and the business closures and the impact of the business closures on banks and customers and consumers in general throughout the country. It was important that we act very quickly. So early on, we have issued a statement encouraging banks to proactively modify these loans, to go out and call their customers. Literally, we said, call your small business customers, call your individual customers. Did you lose a job? You know, there was a Fed study that said that in the month of March, 30% of households making $40,000 or less were furloughed or lost their job, which we knew that in a lot of these communities is going to be a shock to the system because they won't be able to pay the rent, or if they have mortgages, et cetera. So we told banks, go work with them. And then we also worked with Financial Accounting Standards Board, FASB, to make sure that they don't punish banks on the accounting standards and don't look at these loans as being impaired. And so we have done this extensive outreach, frankly, to tell banks, go early, go fast and go early, and do whatever you can to modify loans and to talk to your customers. Go, if you have a forbearance, that's fine. Work through this. And then on your second question, how long are we willing to go? However long is necessary. So we will do what it takes to make sure that the consumers are not disproportionately impacted above and beyond already the shock to the economy that they're experiencing with the loss of wages.
Excellent. Brian?
So Jen, you know, I would echo everything that Yelena said, and I think what you've seen in this pandemic response situation is the coming together of the regulators on this. So the OCC and the FDIC joined with the Fed in a series of interagency statements on these issues. Obviously, the Fed did a great job in providing liquidity facilities to make sure that liquidity stays in the system, and that's one reason you have seen something very, very different from the financial crisis, which is that credit is still widely available and liquidity is flowing through the system. Yesterday, you saw the capital numbers come out of the CCAR test, which show the banks are very strong. So I think it's going to be a very different feel than that. I would say on the macroeconomic front, in terms of these things expiring and you know, your comment about the perfect storm, the economic impact of the last 3 months, I emphasize, was human caused. We were confronting an unknown disease of unknown magnitude, and so we made the collective decision to turn off the economy. That's how this was really different from the financial crisis. This was not that there was underlying risk in the economy. We made a decision to turn it off to address certain unknown health risks. Since that time, we've gotten a lot more data about what all that looks like, and thus we've, in many states, narrowed the scope of those orders and had more targeted responses, with the result that the economic data now looks very, very positive if it can be sustained. And so I was just looking this morning at the fact that, you know, in the last month, retail sales up 16.8%, consumer spending up 8.2%, new home sales up 17%. I mean, there's a lot of very positive indicators if it can be sustained. And I think the issue for consumers is, can we get to a place where the economy is turned back on? If we can, then I think the need for these extraordinary interventions will over time go away. And if not, then they won't. And I guess the last point is one lesson the banks learned in the financial crisis is it's worse for banks to call the loans. It's worse for banks to foreclose than it is to look at loss mitigation strategies. We all learned that lesson 10 years ago, and I'm happy to see most of our banks sort of remembering that.
Terrific. So I feel like we're a little bit in a time warp because we're supposedly in the age of technology in the 21st century, but in the pandemic, we've seen millions of people waiting on paper checks from the federal government to get access to their COVID relief payments. And we've seen millions more people who had limited access to home Wi-Fi and thus unable to access mobile or online banking services at a time when branches were closed or providing reduced service. I mean, many of us, myself included, thought that with the invention of the smartphone and the prepaid card, being unbanked was largely a thing of the past, but it turns out that's really not the case. Now, there are no shortage of ideas for how to expand access to accounts or to expand access to the payment system. And we've heard a growing chorus of these ideas in recent months: postal banking, Fed accounts, digital fiat currency, new charters to bring more fintech players into the mix, and which is something you in particular, Brian, have been talking a lot about. What do you think we can do once and for all to drive the number of unbanked people in America to zero? And how do you think, what are you thinking about these various ideas that are being floated out there? And then finally, what can traditional banks do to attract low-income consumers who frankly are wary of high fees and who in many cases, particularly among people of color, have had poor experiences with banking in the past? I see that Yelena has maybe dropped off. She may be having a technology problem. Let's start with you, Brian.
Yeah, it's a very meta thing. This shows exactly what you're talking about people's Wi-Fi.
We planned this exactly this way.
Exactly. It's a good sight gag. Look, I would say a couple things. So first of all, to your point about things like postal banking and Fed accounts and everything, I think anybody who's been in the Apple store recently and also been in the post office recently knows that we do an amazing job in this country of harnessing market forces and bringing beautiful private sector experiences to people who can afford it and have access. Everybody wants to go to the Apple store. Nobody wants to go to the post office. And I would say if the most aspirational we can be is to consign, lower income people to banking at the post office, that's a bad thing, and I think we can do better than that. So at the OCC, what we're really focused on is what are the institutional barriers to bank access that exist today. Now, I can't solve people's home Wi-Fi systems, but what I can solve is the idea that, as a bank supervisors, we're really requiring banks as part of model risk management to use FICO scores instead of artificial intelligence to underwrite customers. That's a problem when 45 million Americans don't have a FICO score, and so we need to press our technology companies to synthesize other measures of willingness to repay. And as regulators, we need to validate those models and let them be used and let them be spread widely. Another example would be coming out of the financial crisis. We had hundreds of thousands of REO properties, post-foreclosure properties sitting vacant, and the banks and Fannie Mae and Freddie Mac wouldn't sell those for any amount less than the unpaid balance of the defaulted loan. And since they weren't worth that, no one would buy them. That's a giant sort of exclusion of a whole bunch of people from home equity, when what we should have done is had a national REO bank and sold those properties for $100 and carried with them a renovation mortgage so that we could build communities and allow people to build equity. So what I'm really focused on is identifying all the regulatory barriers to people participating, both in bank accounts and also in wealth creation that credit makes possible, and solving those. That's something Yelena and I, from our positions, have the power to do, and I know we're both committed to doing that.
I'm going to come back to you on charters. Yelena, your technology glitch, we were remarking,
it
perfect
did.
time because it just, demonstrated what we were talking about. So thank you for that. You really didn't miss much. But where do you come down on this issue? How do we once and for all get rid of this problem of people not having access to an account, to the payment system, et cetera?
It's a great question. And I would say that the main driver of people not having the account is that they have to see value. So they have to see a value proposition in being banked. And it's not just, I have an account, and I'm being banked, and that's my value proposition. What does it mean for me? Because frankly, a lot of, the FDIC does the survey of unbanked and underbanked households in the United States. And so we go into some of the logistics and the details as to why they're underbanked, including, did you ever have an account? And if so, why don't you have an account anymore? Or how many accounts do you have? And what do you look for in your account? And so one of the things that we found out is that a lot of the consumers got burned by their experience of having an account. And a lot of the unbanked and underbanked households are low and moderate income households. And those consumers, when you think about it, and I'll tell you a personal story in a second, if you have $100 and you put it in the bank and you're actually not really earning interest and you have to go walk to the bank to get your $20 out, right? If you need cash, there's little value proposition to you. You need to see something more, and you need to see the big picture. And the big picture is that you become a part of the banking system, and hopefully with the evolution in that banking system, you get to the point where the system works for you. I obviously have an accent, so I wasn't born and raised in the United States. And so when I emigrated to the United States on my 18th birthday by myself, I had $500. And it became very clear to me that I should put the $500 in a bank, because you should keep your money in a bank to keep it safe, right? And since that was all the money I had in the world, $500, it was important for me to be safe. And so I opened up a banking account, a checking account, the very next day. In July of 1991, I still have the same banking checking account. And from there, I realized I should have a credit card, because everybody seems to be using a credit card. And my consumer ability to purchase, my ability to be a good consumer and use credit would be good, because I could buy more. I could leverage that credit card. And so I applied for a credit card and was, of course, denied. I had no income, no job, no assets. And I was newly arrived in the United States. But I was offered a secured credit card. And then so I sent $300 of my $500 and I got a secured credit card. And after 12 months of on-time payments, they sent me an unsecured credit card. And all of a sudden, I was a part of the banking system. And back then, I didn't know what that meant, but it meant that later on, I would build my credit. Later on, I would be able to qualify for student loans. I would be able to qualify for a car loan, house loan. So I would be able to build equity in the system itself. And I think by becoming banked, people have an incentive to partake in the society. They are no longer disenfranchised. They're members of the society. And I think that is something that banks, frankly, need to work on to educate consumers, why there's a benefit to being banked. And the FDIC has a role here to play as well. And B, how you benefit. It's not just the checking account. It's your ticket to becoming a shareholder in the United States of America and belonging. And I think that's something that we all, both banks and the regulators and the industry as a whole, have a lot more work to do to sell the premise of why being banked is a value proposition to the customer itself.
So, Yelena, do you think the banking system we have today and the banks that we have today are sufficient in order to tackle these issues? Or do you think that somehow digital fiat currency and direct central bank accounts, for instance, which are being bandied about quite a bit right now, are necessary, or there's something else that's necessary as what I would maybe call an account of last resort?
Right. So I think that more choices for the consumers are better, generally better, right? But there is such a thing as having too many choices and getting stifled in your decision making with too many choices. And so I do think that there is an opportunity for banks to think anew. For challenger banks, we have seen a number of challenger banks coming in and offering online-only accounts with no fees whatsoever. And then we have seen fintechs in this space as well. So the question is, which of this venue is going to serve the customer better, especially that unbanked consumer that is looking for why should I have an account, right? And what is the benefit to me in the long term? So I do think there's an opportunity to work with the existing infrastructure to allow new infrastructures to come in, and all of these challenging either banks or models or fintechs or technology companies that are not even fintechs in this space, and to do so in a responsible way, which is why I Brian is wise to think of the national bank charter as with a new lens. And at the FDIC, we're also trying to make sure that fintechs and these challenger banks and the new companies understand you can become a part of the regulatory framework, and you can offer these products to customers. And yes, we will take your application to consider you for deposit insurance, which is, the good housekeeping seal of approval from the FDIC. But at the same time, we want to see a value proposition to the consumer. We want to see the number of unbanked and underbanked in the United States coming down. And we want more people as a part of the system, because frankly, there is a symbiotic relationship where the system benefits and the individuals benefit in the long run.
Yeah. So both of you are really bullish on creating more competition in the market. Yelena, you granted a charter to Varo and have been doing more with the ILC charter in terms of FDIC insurance. And Brian, you've been talking a lot about chartering. Tell us a little bit about how you're thinking about this, and especially how you think you can move forward given the legal uncertainty.
Yeah, well, so look, first of all, I would just come back to the point you made a second ago about how confident are we that the current system can suffice to bring everybody into the process. And I think the answer is, we need to redefine the current system. That's kind of the insight behind this chartering discussion is, look, the legacy banks, and certainly the larger legacy banks, are existing to serve the middle 70% of the country, who are perfectly well served by the status quo. And they have a series of highly scaled, highly uniform products that most of us use and want. But those products don't necessarily serve the top 1% or the bottom 30%. And that's the whole concept of saying there's now fintech innovation that is designed to serve those people. So you mentioned Varo, which is an example of a bank charter applicant. By the way, the charter hasn't yet been granted, but we're on the cusp of that, I hope.
Thank you for the correction.
Where the whole point of it is to serve a segment of the community that isn't currently well served. There are lots of other specialty companies that are realizing, hey, certain communities need a bespoke solution. They're not going to work with the off-the-rack product offered by the biggest banks that serve the majority, right? And so innovation and specialization is key, but that's only going to work if we can bring them into the system, meaning they have to be supervised and be safe and sound. They need to comply with fair lending obligations, those kinds of things. And if we don't do that, these communities are not going to have confidence to take advantage. So that's my vision versus, the postal banking vision or the Fed accounts vision or whatever, which is, hey, let's make those people go through the grinding gears of government to get their financial services versus having a beautiful customer-focused experience that gives them what they actually want. You mentioned the legal challenges of granting some of these charters. What I would say is, I litigated cases, including bank preemption cases, for 25 years of my career. So I feel like I have a pretty good handle on what the legal implications of these things are. And all of us who have done that in our lives know that on any given day, a given district judge might rule against you for whatever reason. Well, obviously, we take that opinion very seriously. We've carefully scrutinized. We think it is a scholarly opinion of one judge among the 93 districts in the United States. But the district judge in Brown versus Board of Education ruled for the city and against the Black plaintiffs, right? And nobody thought that was the right decision. And in a great moment of heroism, they took that to the Supreme Court and won. We're going to do that here. I mean, we have 100 years of history of the OCC getting deference in its definition of bank powers, the scope of eligible bank charters, and everything else. And so, with all due respect, I don't think one district judge out of 93 is the last word on the subject. There are a lot of other parts of the country. We have a long history of Supreme Court precedent on our side for this, and that's really what we look to in defining what our chartering powers are. And I'm not going to let those powers get eroded on my watch.
So let's continue talking about technology. While the two of you have taken a similar approach in some ways, you also have very different audiences, right? So Yelena, the FDIC largely supervises small community banks, many of whom are challenged, frankly, to keep up with technological change. While you, Brian, you want to be the nation's first fintech controller. And you really make the case that doing so is going to drive financial inclusion. So how do you think about this right balance between high tech and high touch to drive broader financial health and well-being? And how do your agencies strive to strike that balance, especially given the differing audiences that you both are serving? Yelena, you want to start?
Sure. It has been one of the main things that I have frankly focused at the FDIC for the last couple of years. And here's why. Our audience truly is community banks because we're the primary federal supervisor for the community banks in the United States. And while we have the supervisory authority over all banks in the United States, it's by the virtue of the deposit insurance mandate and the resolution mandate. And so when we go and look at these community banks, quite often they're located in rural communities. And it's in a community where they may have one or two branches. They've been around for a long time. They have banked the farmer in town and the farmer's great grandfather. And there is a sense of a community built around those community banks, truly a sense of a community. And so if those banks are no longer able to survive, those communities will suffer because frankly, they will have to move their banking services online, or they will have to drive to the next town, which in some parts of America is 50, 60 miles away, in some cases even longer, even further away. And so when we look at the very survivability of community banking model in the United States, technology is an absolute must. They have got to adopt new technology and adapt to the changes in the system as the larger banks are doing it. And yet they don't have the economies of scale to do so efficiently. It's costly. They have to spend a ton of money on BSA, Bank Secrecy Act, and anti-money laundering compliance. They still have to do all of the requirements we pretty much ask from the larger banks. We just scale some of them down for the size and the risk profile of the smaller banks. And so what we have done at the FDIC, we have done a couple of initiatives. We created a tech lab, FDI Tech, which is our innovation office, where we are thinking, frankly, how can we do a little bit more to ease the burden on community banks and allow them to adapt this new approach and frankly, not go the way of the blockbuster, right? You want them to persist and continue for the next 100 years and continue to service the farmer's great son. And so we're looking at all of these things and frankly looking on our regulatory side as well to see, are there regulations in place that are stifling innovation? Are we kind of applying this archaic system that when you really think about it, our regulations come from, in Brian's case, overarching regulations 1865, the Federal Reserve 1913, FDIC 1933, and we're looking at, and they have changed over time, but still that framework was set up at a time when you couldn't imagine of a wireless technology. You couldn't imagine that you could communicate, cell phone. What is that, right? And so we're trying to tweak the regulations to these old regulations to fit the new model and allow innovation so that we actually can do more with technology and allow community banks to frankly survive in the long term.
Brian, what do you have to say on this topic?
Well, I'm actually super optimistic about the impact of technology on community banks. So I'm going to always take sort of the positive side of this. I think in a number of respects, it's true that it's expensive for a community bank to build its own website or try to build its own, cell phone app or something like that. That's hard to do. At the same time, if you think about it, community banks historically have been super beholden to a small number of core processors, the FISs of the world, to do a lot of things for them, to do their card processing and a series of other things. What's great about fintech, of course, is that now community banks have more choices and more unbundling abilities to sort of buy data from certain kinds of companies or to access credit information without relying on a tech. I mean, one of the single hardest things for a community bank to do is to meet ever increasing compliance burdens and risk management burdens, which we impose on them, particularly in the post-crisis era. Enter reg tech, where suddenly you can automate a lot of those processes, so you don't need to hire 50 compliance officers. You can hire 5 compliance officers and let the computer kind of do the work that otherwise would have been done by a lot of manual loan review people or risk managers. So I think those things are quite good. At the same time, I keep emphasizing a lot of these fintechs that are going to want special purpose charters from the OCC are going to be small entities themselves. They will look a lot like community banks, but in a more focused area, typically in a more focused vertical, focused on some of these underserved constituents that you're talking about. So I actually will take the positive side of all this. In the end, it'll make it easier to run community banks, and they can focus on what they're good at, which is relationship management and credit management.
And Jen, if I may just add,
Please.
from the FDIC's perspective, we have to think outside of the box a little bit, right? And so we are thinking about, exactly to Brian's point, how to deal with these core processor issues, because banks, small banks in particular, they could use more competition. Again, more competition is good for the consumer. In this case, it's good for the community banks. And so I want to put a little plug in for something we're doing next week. We're going to announce on Monday. We're going to engage in a very interesting tech event that we're organizing at the FDIC to do a little bit more in this space. And for the announcement, you'll just have to stay tuned until Monday.
Okay.
Teaser.
Cliffhanger, season 1.
I'm thinking tech sprint, but I will wait patiently till Monday. And I'm thrilled that you're going to tackle the core processing issue because there's a sector, there's a corner of the sector where the benefits of technology haven't yet been brought to bear, if you will, for smaller players. I want to go back to something you were talking about just a minute ago, Brian. There are so many ways in which technology can be brought to bear on the way banks do their business, both to gain efficiency, also to promote greater access, more inclusion. One of those arenas that I think is getting a lot of scrutiny, not so much from banks, but in general, is the use of AI for all kinds of decision-making, underwriting, et cetera. And there's increasing concern about it, particularly from a racial equity perspective. So on the one hand, you could say, oh, well, now it's technology, so it's colorblind, right? I'm not seeing the person in front of me. That should make it more fair. But at the same time, there are real humans who are teaching the AI to do what it does. And we all have biases, whether we recognize them or not. And so how are you thinking about this development? And what are you both thinking about doing to make sure that as that technology makes its way into bank decision-making, that it's being done in a way that is ultimately bias-free?
Well, maybe I can start on that, Jen. And so I come at this with two kind of premises. So the first premise is there's not a lot to defend about the status quo. So people who say, oh, be very aware of AI because there might be bias in it. I see protest marches in the street about the amount of bias in the status quo. So I don't think that it's about having a bias-free world. I think it's about having a less biased world than we have today. So people can debate me on that, but I would begin with that premise. And then the other premise I have is this, which is, and again, maybe people would take me on this, but right now the credit underwriting systems we have in this country, the very best of them, only capture about 60% of credit performance, meaning that 40% of the time, they're either approving loans that are going to default or they're denying loans that wouldn't have defaulted. So they're both over-inclusive and under-inclusive. They're highly, highly flawed. So the second premise is, if you could use AI to achieve a world where every single loan that should get made gets made, and every single loan that shouldn't get made gets denied, wouldn't we agree that would be the ideal world, sort of regardless of what the underlying sort of social justice implications of that should be? Like, we don't want to make loans that are going to default. We don't want to put people in a foreclosure if we can avoid it, but we also do not want to deny credit. So when people talk to me about AI and the implications of that in credit underwriting, what I think about starts from those premises. What I believe would occur when we start unleashing AI on underwriting is something that we need to debate as a society. And that is, I believe that we would significantly increase the number of minority loans that get made compared to the status quo. And I also believe that it's possible we would increase the statistical disparity between minorities and non-minorities. And the reason for that comes back to what I said earlier about the 45 million Americans with no credit score. Those people do not get considered for loans today. So they're not in the statistics, and they're heavily minority, okay? Once we bring them in, imagine a world where we could make 1 million new African-American mortgages that currently don't get made. So 1 million African-American homeowners are created. But imagine that the approve deny statistical disparity goes up by 30 basis points. Is that a good thing or a bad thing? I think reasonable people could actually debate that. And as a society, I think it would be good for us to have that debate, because the fetishization of statistics over human beings' life aspirations, to me, is probably the wrong balance. I would rather see more people getting credit, even if it means that there's a statistical artifact that makes it look unfair, than to consign those million people to a life of renting because I don't want a statistical disparity. But that's a legitimate policy debate we ought to have as a country.
Well, I'm going to take you up on that. We should offline, let's talk about organizing that, because I think you're exactly right. That's a really important discussion to be had. Yelena, what's your take on this?
So I'll say that discrimination in lending and banking practices is illegal, and that's something that we enforce. And as Brian pointed out, there is a huge potential with respect to artificial intelligence to actually bring into the fold people who are not in the fold right now. And there are shortcomings to artificial intelligence, and those, maybe version 1.0 is not the version we end up with. Maybe it's 3.0, and we tweak the issues as we come across them. But I think that discounting what artificial intelligence can do in this space on the premise that either it is biased or that it is not going to provide enough for X, Y, and Z borrower, whatever the characteristics of X, Y, and Z borrower may be, is just going to, frankly, prevent thousands, if not millions, of other people being able to utilize that, the benefit of the artificial intelligence. So I think it's something that regulatory agencies have a lot more work to do in this space. And this is something that I think we're just beginning to tackle. We're struggling with exactly how to supervise for AI biases, or AI technological aspects. Quite often, a lot of these companies are on the cutting edge of the technology, and our examiners need to develop skill sets to catch up in some cases. So we constantly train our examiners. As we learn of new developments, we try to incorporate them in our training, and then we try to work with banks, frankly, to make sure that the 2.0 model is a better model, right? Because we want the 3.0 model to be able to expand lending, expand financial services, and bring more people into the fold. That's ultimately the goal.
Okay. I want to shift gears just a little bit now and really talk more specifically about financial health and the role that banks should have in promoting it. So when we define financial health, we think of it as when you have a day-to-day system that enables people to be resilient and to thrive. So essentially to manage the downside and to take advantage of the upside. When you tend to think about financial health at the consumer level, I think most people tend to think about the CFPB, the Consumer Financial Protection Bureau, given that its mandate is to protect consumers. But obviously, there's a three-legged stool, as we like to say, right? Safety and soundness being one of them, consumer protection being another. And I think both of you would say, and many others would say, creating an enabling environment for innovation. So recognizing that you have to balance all of those, what do you think the role of banks is in promoting the financial health of their customers? I'm particularly interested in how you think about that beyond their Community Reinvestment Act mandate. And do you think banks are properly incentivized to design the kind of products and policies and services that actually build the financial health of their customers and their communities, when often it feels like the incentive may be perverse? It may be, they make more money from overdraft, as an example, than causing someone to not overdraft. So talk to me about how you think about the role of banks as it relates to the financial health of their customers. Yeah,
Yelena, you want to start?
Go ahead, Brian.
Sure.
No, I was going to turn it to my friend.
Go ahead, Yelena.
All right. So the way I look at the financial health of consumers is, are you living in fear of being able to pay your bills? And are you living in fear of not being able to feed your family? And is $100 a difference between you putting food on the table or not? And a lot of people are frankly in that fear category. There's data from the Federal Reserve that says 60% of Americans do not have $400 they would have to borrow, either from a friend or on a credit card, if in a case of emergency. And so as we think about what are the incentives in the system to promote a financial well-being of consumers and bank customers in particular, you have to think through the lens of a bank. Bank wants more customers, right? By the economies of scale work in such a way that more customers you have, broader your base, cheaper the products, the cost of the products that you can offer, and so you expand your base and you grow. The problem becomes that in order for a bank to acquire new customers, they have two ways of getting them. They have to take them away from another bank, or they have to go after the unbanked and underbanked customers who are not banked. And frankly, one proposition going after another bank's customers is more expensive than going after unbanked and underbanked. And this is the irony of the game, because it'll cost you several $100s to take another bank's customers. You have to provide incentives for opening a new account. You have to show the value proposition, why you're a better bank than the previous bank, and why you're not going to charge them, say, overdraft fees like the prior bank. Because the truth of the matter is, when that customer gets sixth or seventh overdraft charge, they will find a new bank. They will try to find a bank, even if it's an online-only bank or a tech company, Fintech, that's going to provide services without charging them that overdraft fee. And I think banks are getting to this point where they understand that getting new customers is so important, and maintaining good relationships with the existing customers, and this is where social media played tremendous influence, that they are working, I would frankly say, they were working hard in figuring out how to retain the customers and how to reach out to the new customer and offer the value proposition. And so what we have done together with the OCC and the Fed is take a look at this and say, what does that consumer who doesn't have $400 need? Well, they need $400 and they need it from some source. Do we want banks in this space? Yes, we do. Why? Because more competition is good, drives the cost of the product down, and we can supervise for both safety and soundness and consumer compliance, which is not something that necessarily gets done for non-bank providers in the small dollar lending space. And so we put together, our staffs and our heads together, and we said, can we issue joint guidance on small dollar products and services? And so we did that about a month ago, and it could not have been more timely, frankly, because I think it's going to be crucial that banks are in this space offering small dollar products, and frankly, building value for their customer, because that customer that comes in maybe just for that small dollar loan will 6 months later, a year later, open up a checking account. And maybe a little while later, they will open up a savings account. And maybe they can only put $20 a month in that savings account. But that's going to be something that later on, they will bring their kid to open up an account. And so there's this benefit. It's an ecosystem. And the beginning of that ecosystem is treat your customer well. And you as a banker, as a bank, need to be highly invested in your customer's well-being, because frankly, if you're not, you will lose the customer and the system will be worse off for it.
Brian?
Well, let me take it in a slightly different direction. So I think that I come at this from the proposition, maybe there are two, that growth is a great thing, and too many people have not been, allowed to participate in growth economies. So, the last 20 years, if there's one lesson, it's that equity holders got much, much, much richer, and people who worked for a wage-earning job, particularly an hourly rate wage-earning job, stayed flat, and so those people are even fell behind. So I think what financial health means is that you're able to move forward in the case of a lifetime. That you may start, as I did, making $2.01 an hour plus tips, and then one day you may make a lot of money in some other profession, because there are ladders, banks at every stage should help you get to the next rung on the ladder. I think the problem we have today is, for a variety of reasons, the incentives of banks and the incentives of consumers are not aligned as well as they need to be. And the post-financial crisis environment, we don't want there to be any risk in the system. And so here's the problem, is when you lend or provide other financial services to people who are lower on the credit spectrum, they're higher risk. And if we've decided we don't want any loans to default, the only way to make sure no loans default is to not lend to anybody who isn't rich. Right? Again, talking as a kid who grew up in Pueblo, Colorado, and waited tables for $2.01 an hour plus tips, I want and need credit to be extended to me, even though I might have a little bit of default risk. So how do you solve this? Well, this is where I think there are innovators out there, many of whose stories have not been fully told yet. I'm going to tell you one story right now, but there are innovators who are trying to solve this. So here's a great story. When I was in my private sector life just 6 or 9 months ago, and I was living here in San Francisco, I was advising a company who was looking at ways of having a more inclusive mortgage product. And I came up with the idea of what I called the foreclosure-proof mortgage. Here was the concept behind it, right? And this is like an example of how do we align interests. The idea is loans typically are a fixed price thing, right? You borrow $100,000 and you have to repay $100,000 no matter what happens. If the home value declines below $100,000, you still have to pay $100,000. And so when you're underwater on your mortgage, you tend to default. That's one thing we learned in the financial crisis is the riskiest product was the the zero down payment pay option arm where people had no equity. The concept of the foreclosure-proof mortgage was, what if you had a loan where if the appraised value of the home fell below the loan balance for a certain period of time, the payoff amount would reset to whatever the home value was. So you'd constantly preserve equity in the house. What studies show is the bank wouldn't lose money there because people aren't going to move out of the house. They just want to know that their balance out there is such that if they sold the house, they would still have equity to extract. What that would do is it would preserve the monthly payments and reduce the likelihood of default. It would keep people feeling stable and secure in their house. And it would also promote labor mobility because they could actually move without losing money. What a great idea. I mean, that's a way of aligning incentives through innovation. So I believe the problem has been that for a variety of reasons, both risk intolerance and just a failure of imagination, we have allowed consumer interests and bank interests to diverge. I think one of our roles as regulators is to bring those interests back into line.
As I said at the beginning, we have a lot to talk about, and I knew we would run out of time for it. We're going to have to leave it there. I think that was a good note to end on. I really appreciate Jelena and Brian being with us. Thank you so much.
Thank you. The pleasure was mine. Thank you. Bye-bye.
Hi, I'm Mary Wisniewski, and I'm the banking editor with Bankrate, and I cover Fintech. And I'm so pleased to welcome everyone to this panel on the future of financial health. It's mattered forever, but in this time, I mean, this is wild, this is crazy, and it's horrible. We have, vanishing incomes. We have like so many inequalities going on, and it's just such a nuanced problem. And that also means there's a lot of opportunities. So we have great panelists today from different perspectives, from the tech side of things, from the policy side of things. So it should be a great chat. And I'll quickly introduce everyone. We have Lawrence Bailey, who's the head of national sales and community and business development at JP Morgan Chase. We have Darlene Goins, the senior vice president and head of financial health of philanthropy at Wells Fargo. We have Gigi Hyland, the executive director at the National Credit Union Foundation. And we have Tim Spence, the executive vice president and head of consumer banking, payments and strategy at Fifth Third. So there's so much to unpack here, but I think we should start about the inequalities that are going on. We saw a few weeks ago that the personal savings rate hit a high at 33%, and yet that's not true of everyone or everywhere. And I thought maybe we could start this conversation unpacking some of these nuances and just how this is affecting people in different ways. So Lawrence, I hope to start with you about, on one hand, we have this, savings rate is high in theory, but, let's dig a little deeper. What are you seeing? What's going on here?
Yes, that's a good first question. And let me start by thanking you for having all of us. I know we're excited to have the conversation today that we're about to have. And yeah, you see a lot of statistics. I saw the same statistic around the increase in savings. We just put out a report that showed about 35% increase in savings. But as you mentioned, that's a very different story for different people. So first of all, the two things that are driving that are the stimulus money that's being put into the system, and then the increase in unemployment benefits. But that's driving that specifically for what we call the low to moderate income families in terms of the savings rates. And the question is that sustainable? And I would say that it's not, because you can't continue to put that kind of investment, whether it's stimulus or unemployment, it's not going to continue. So that's inflating the savings rates. On the wealthier side, the savings rates being inflated by the simple fact that we're spending less. There's less places to go. We're at home. We're not shopping. We're not buying the big ticket items that we typically buy. We're not traveling. So unfortunately and fortunately for the wealthy, that savings is sustainable because it's teaching us, new habits. And there's only so many things we can order online. At some point, you run out of things and you start to look for what else can I order, and you're just out of things. So the sad thing and the opportunity for all of us in fintech, banking, across the spectrum of financial services is, what do we do to help those low to moderate income families? What tools, what education, what are the things that we can all do part of the community to make sure we help them? So there is a path post this government, intake of all the money. What can we do to help those folks? And that's the challenge in the conversation we're going to have today around what are we all thinking? How are we thinking we can really have a sustainable impact for those families? I know at our firm, we're thinking about things like savings. We're thinking about things like the right products. And we're always thinking about education. But you have to have the products and services to go with education. That's an old trick that's been used. You educate, but you still need access to services, whether it's through fintech or whether it's through the retail perspective, from a banking perspective. So that's just how we're thinking about that. But it's truly, Mary, a big impact that's really we see for the low to moderate income families, that I don't think the savings rate is sustainable.
Yeah. So, that's really, helpful to understand. Thank you for that. And I wanted to, before we talk more about those solutions or possible solutions, Darlene, I thought it'd be interesting if you shared what you've been hearing on the ground floor of what are some of the thorniest issues facing, people struggling the most right now? What are you hearing?
Sure. What we're hearing from our philanthropic partners and nonprofits, our grantees on the ground, is that cash in hand is so critical right now, especially for vulnerable communities. People need cash for rent, food, utilities, childcare, other basic needs. And during this time of high anxiety, stress, and uncertainty, people just need help. They don't want to, nor should they have to, try to navigate these financial challenges alone. We're hearing that the hardest hit communities are communities of color, who often lack liquid assets, people with disabilities who may have lost their personal assistance services and jobs, and who worry about how the stimulus checks might impact means-tested eligibility for public benefits. We're hearing about immigrant families who don't have the luxuries of paid sick leave and access to unemployment benefits or social safety net protections that can help them weather the storm. People who are unbanked and underbanked who may still be waiting for their stimulus payment because they didn't have a bank account on file with the IRS. And then something we heard about yesterday in one of the sessions, there are seniors that were already aging into financial insecurity due to longer lifespans and the disappearance of defined benefit pensions. And so, there are some vulnerable communities that are really struggling, and, cash and help navigating these financial challenges is so critical right now.
So, possibilities are endless in terms of financial health. We dialed into a lot. Tim or Gigi, are there any things that you've noticed from people that you'd like to add onto that list that we were talking about?
Sure. So I think there are a few things. I agree very much with the prior comments, but I think they're probably the two things that are worth adding are, one, this crisis, the nature of this crisis, has had a huge impact on the unbanked, right? It's easy to forget that almost 1 in 5 U.S. citizens still qualifies as underbanked. And it's pretty difficult to buy something online if you don't have access to a payment card. It's very difficult to get your stimulus check if you don't have a direct deposit, a piece of direct deposit information on file at the IRS. And many of the communities that we're talking about are also communities that are not served by any regulated depository institution, whether that's a bank, a savings bank, or a credit union. And the byproduct of that is even the access points are really limited for them. So I think we have worried a lot about the role that we could play in helping the unbanked population to navigate what is a crisis that was almost tailor-made to hurt them. I think that's one point. I think the second thing that we have thought a lot about, and that I think is important in particular as we talk about where we head from here, is we're adaptable. Human beings are adaptable. We're adaptable people, and I think many of us are either accustomed to living with abundance or we're accustomed to living with scarcity, and we know how to do those things. What's very difficult is to take folks that are living with scarcity and all of a sudden to put them in a situation where they have abundance, which many people with the advent of the stimulus checks and the enhanced unemployment, like Lawrence mentioned, have had to make the transition to experiencing. And conversely, if you're somebody who's accustomed to living in abundance and all of a sudden you have to live in scarcity, it's a very difficult transition to make. So the things that we can do to help people psychologically and behaviorally to navigate those major shifts in their financial circumstances, we think is also a very important part of the way that we respond to the pandemic.
Yeah, I would echo all of those comments. I think that's a great summary of where we are. I think what's hard is the path forward, knowing that this crisis is very different from the last crisis, the Great Recession, that this is an income issue. This is the world stopping for 3 months and people all of a sudden losing their sources of income. And then, as was just noted, having then this influx of whether it's stimulus checks or unemployment benefits and how to navigate those things. So I think as institutions think about this, we are all doing probably skip a pay and forbearance and a variety of other mechanisms to try to help people with their cash flow. But that can only last for so long. And I know, I think the other challenge is as regulated financial institutions, there's a real conversation that has to happen with the regulatory community to not necessarily treat this the same as they did the Great Recession, because the issue is under nobody's fault. They can't pay because there's no income coming in the door, and everybody is in that situation. And so how is a credit union or bank supposed to allow forbearance potentially for 180 days or more, depending upon how long the crisis lasts, and not have on the back end a negative regulatory kind of rebound effect that doesn't allow them to actually serve the people that most need service. So I think that's the other twist that I would add as we look forward, that's going to be a very interesting dance as we go forward.
Is an interesting dance. And Gigi, you raise up another point about fees. There are breaks right now. And, over the years, banks get blasted all the time for the fee model that they charge consumers. And now you have this period where there's a break. This came up, I think, in Jennifer's chat right before. But what do you will banks go back to a fee model? Is this going to change it in some way? Do you think, what are you feeling about the fee model and the temporary breaks?
I think that's a really great question. I can only answer or try to give an answer from the credit union perspective, but I think it's really going to be challenging to try to figure out how you go back to non-sufficient funds, NSF fees, or other fees that may have been part of sort of your return on assets in a time when you've been able to not have those because of the circumstances. So to your point about opportunity in crisis, what is that opportunity then around either contactless or digital that perhaps could drive more fee income, but also can meet the member, in our case, the credit union member, where he, she, they are in life. So I don't have a really good answer to that question, but I'm having trouble kind of seeing through the fog of whether we could actually go back exactly to the way it was, because the world is not going to be the same way that it was.
Right. I know. And it's so hard to know what habits will stick and what habits won't stick. But I think another interesting wrinkle to all of this is that, on one hand, there's always been this assumption that like mobile banking can reach a wider audience, but it's been, coming up a little bit more like, what about for the person who can't pay Wi-Fi and can't go to the public library, and also, maybe the phone is an older model and can't support the most recent app that in theory is supposed to support. I mean, what can we do here? Do we know?
Hey, Mary, I'll chime in on that. I think it's a good conversation. I think what Tim was saying earlier, though, I think we'll navigate going forward how that looks and the balance. But I think the core thing that really has evidenced itself in this pandemic, which quite frankly should not surprise me, I'm sure, to most of the people in the audience, given the audience, is the behaviors that put people in the situation they're at today. So when you think about like, how do we teach them how to budget? How do we teach them how to save, which is really a big anchor when you see the lack of savings, and that stat that I continue to sits in my mind that 42% of Americans don't have $400 in savings. I mean, that stat we all hear and it blares in my ear, but then you anchor on, okay, now how do we make sure that going forward, they have the education on how to budget, they have a plan and the tools to save, and then we lower the access and the barriers to get into banking. That's a key point that Tim mentioned as well, lowering the barriers to get into mainstream banking at the right point, because in turn, that does allow you to have lower fees, if not zero fees, depending on the right products. It allows you, when you think about the education on budgeting savings, to avoid some of the pitfalls with NSF and OD. And we talk to a lot of our clients, and that's what they're telling us. Like, today it might be late because they're in this environment, but let's just make sure that we're going forward, we have a plan, because I don't care if it's pandemic, natural disasters, unemployment trends, businesses moving in and out of places. The low to moderate income community, as Gwen mentioned, are always hit the hardest. So that's where I think about all the things that we can do, and the conversations we continue to have are the right ones, and you're asking the right questions, Mary.
Well, and you're opening it up. Mm-hmm.
If I can jump in, then, because I agree, I think that we need to do more around providing access to banking, but I also think that as an industry, we have really looked at financial health from a purely financial perspective, encouraging people to save more and reduce debt and build credit. But we haven't done such a good job of really considering the full context within which they're making those financial decisions. So their housing situation, health, employment situation, diversity dimensions, social circumstances, and that context is influenced by policy and regulation. And that's influenced by oftentimes very false and damaging narratives. And so I think that we now have an opportunity, I think to Gigi's point earlier, to sort of reimagine what our society should look like and try to influence the policies and regulations and those narratives so that we can provide a better context within which people can make financial decisions.
And I think to build on Darlene's point, I think part of that too is there's a great deal of need for empathy of all of our financial services professionals. Is really whether it's walking in the shoes of another, or truly understanding, to Darlene's point, that context, that we make judgments about how people decide their finances, and as an example, whether they go to a payday lender or not, or a title lender or another predatory lender, and not having the context of why that decision is being made in the life that person is currently leading is a dangerous assumption. And that in itself is a barrier to those people coming, I think, to regulated financial institutions, because it's, you don't get me. You don't understand what I have to deal with and when I have to bank and how I have to bank and why I'm doing this. I think that empathy conversation is really important. It's a conversation that we are definitely fostering in the credit union space. Even though, we're not-for-profit and mission-oriented by charter, it's still a really important conversation for the financial professionals to be able to have that understanding in order to meet the person where he or she is with the right products and services, as my colleagues have said.
And I think that's such an important point. Now, Gigi, illustrate that for us. What would be an example that you would love to see, like a bank, like here's this person, here's how one might want to think about the scenario, expressing that empathy. Is there a concrete example you'd think of?
Yeah, sure. I think the example of, using a payday lender or a check casher and really not understanding the options that somebody might have based on a previous credit history. So, if I'm a young person and I have a whole bunch of credit cards that I decide to run up, I get in a lot of trouble with those credit cards. All of a sudden, my credit score is really abysmal, and really my only opportunity to do banking is with alternative service providers. And yet a traditional financial institution, credit union or bank, might judge me as, well, why didn't you just come to us? Well, you wouldn't let me in the door. So, and that it's that empathetic, how do you help people when maybe they have really bad credit or underserved or fearful from a cultural perspective? I mean, I've got a great story from a credit union in Indiana who's working with the Hispanic population, seeing a woman come in and cash really large checks. And she was doing that for her Hispanic community. And the credit union was like, how can this be in our community? Why aren't they using us? And, going down that path of empathetically trying to understand why they weren't using us and trying to find a way to fix that. So it's that context, I think, is everything. So hopefully that's a good example. I'm sure my colleagues have others that they've seen. So please, yeah.
I want Tim or Lawrence,
Yeah.
Sure. I'll take the bait on that one. I mean, I really think that it starts with being present. And I think that that's a topic that, as an industry in particular, as many of us look at our branch networks and look at changes in customer behavior, that we're really going to have to grapple with. Because the reality is, for the segments of the population that most need the support of financial institutions, whether they're banks or credit unions, getting support and getting advice is still very much an in-person experience. So I think that's the starting point, is making sure that we find ways to be present and be relevant in all of the communities that we serve across the markets in our respective footprints. I think secondarily then, it starts with, I think it was a point that Lawrence made earlier, which is meeting people where they are. So it doesn't make a lot of sense to spend time talking to somebody about banking fees if the issue that they're running into is they don't have enough income to support their regular expenses. The starting point in that scenario is an understanding of what your regular expenses are, and then doing what we can as an institution to provide advice on the best path to meeting those expenses. So I think you have to be present to begin with, and then you have to be relevant. You have to be willing to meet people where they are, as opposed to starting with the products and services you have available and trying to fit people into them.
Lawrence, did you want to add anything to that?
No, I was actually agreeing, which is why I love this panel, and I know we spent some time together. But I think that what Tim and Gigi have said is spot on, and I would just anchor on meeting the people where they are. I think there's a balance, and we've seen that shift from a digital shift to a brick and mortar shift. And as we think about going forward, right now, we didn't really have a choice to shift to the digital experience because of the pandemic. But we're also making sure that we don't go too far, because there is people, to your point, Mary, who might not want to bank digitally, might not be able to bank digitally, and still need to have that brick and mortar. So I just anchor on what I kept hearing from my peers, which is meet them where they are, make sure that we have access, and then again, lowering the barriers, which is what you hear, lowering the barriers to these products. And then I also love what you said too, Gigi, as well, as Gwen said it too, which is you got to go a step before that. And that's that step before that, which is, I get it, but I need help back here. So it's so many things that we need to do from a community perspective, from a nonprofit perspective, a government perspective, and a financial services perspective. We need all of these kind of entities to work together, because the problem is and has been a little bit bigger than just one of us.
Yeah, there are so many, there are just so many threads to pull on here. Two things I wanted to dial in for sure while we're still chatting is promising technology. I did bring up, it's not, well, there's no silver bullet for anything. That's just life. But I mean, any kind of promising technology in the context of banking that you think can help, I guess, from my perspective, it's always been focused on helping people change their habits, but now we're dealing with bigger factors here. Again, vanishing income, it's not a useful tool for someone who doesn't have income, but are you bullish on any technologies that you think can help improve someone's financial health in any capacity, to pay down debt, to build up savings, or anything on your radar right now, or that you're exploring as part of this solution?
Maybe I'll start on that one. I think we're at a very exciting point in time, because technology allows us to interact with people in a much more intimate way on an ongoing basis. I know we talked a little bit about saving. The experience you had at a financial institution 25, 30 years ago involved a physical passbook and a savings account that paid an interest rate. And those two things aren't that useful if the issue you have in achieving a savings goal is establishing a budget and finding small ways to move money into the account on an ongoing basis. And technology allows us to do those things. I also think technology allows us to give people much greater visibility into their spending patterns and behaviors. And those things are the key. That's the initial step. Understanding where you're spending your money today is the initial step to establishing a budget and to moving from a model where you are borrowing to cover regular and recurring expenses to one where you're saving in advance and you're in a position that you can handle unexpected events. I think the third thing that's really exciting in the context of the current pandemic is technology is allowing people to do income discovery in ways that maybe they never have been able to do before. We announced earlier this week a partnership with a tech company called Steady as a mobile app that with very few limited pieces of information helps you to understand based on the number of hours you have per week available, when those hours are available, and what skills you have, the best ways for you to generate income with your spare time. And then they do the connecting for you, whether it is gig economy work or more permanent work or otherwise, so that you can get yourself signed up, enrolled, have the background check completed, and start making income in relatively short order. Those are just things that weren't possible when we had to go to the classified section of the newspaper on Sundays to do income discovery. So I think across the spectrum in terms of improving financial health, technology offers a really important tool. We just all have to recognize that you put the technology out there, people don't automatically figure out how to find it and use it. So it will, we firmly believe, still require coaching and advice and support along the way.
I would build on that. The foundation was privileged to work with the Financial Health Network and Members Development Company, which is a credit union-owned organization, around 5 promising technologies last year, and did some research on that. And one of the ones that just really caught my eye is augmented reality and virtual reality. You know, there are great statistics that say that we can't even remotely imagine ourselves in 20 years. We don't know that person. That person's a stranger to us. And so if you think about that and using AR, VR to help people be able to literally see, in quotes, the potential choices that they make and the consequences of those choices vis-a-vis their financial health and well-being. Whether, you know, rent to own at this stage of my life, or do I really need a car? Can I use public transportation? And just, is there a way to leverage that technology, which I think throws a little bit of fun into the mix, because, you know, budgeting is just such a lovely, engaging topic for most of us. How do you make it very real and leverage all of our fascination with YouTube and watching videos and people dancing in quarantine? How do you leverage technology in a way that for people, financial health is very real and they can do it? It can be empowering. And so for me, AR, VR is really kind of inspiring. It feels very Trekky, but it's how do you see your financial future in a way that you can make better decisions right now? So that's one I would throw out there for consideration.
Oh, I love that one, because yeah, budgets are dreadful for sure, regardless of like your income. They're just awful. Very depressing experience personally. But this is a related question, and I feel like it's a good tie-in maybe for Lawrence. It's still to the technology. Oh, it could be broader than that. But audience question is, what are banks and credit unions doing to make it easier to implement what consumers already know what they should do? So budgeting, emergency savings. So it's basically like, you know, for those consumers who know these are best practices, but the behaviors aren't doing that. You know, what are you seeing, Lawrence?
You know, I think it's a good question. I can just tell you what we're doing, but I do think the reason why I love the banking industry is because, I hate the word, but it is a copycat kind of industry. So, and it's a good thing, because we're trying to help more consumers. It's not about competition. It's about how many consumers can we help. So it's okay if we have some of the same ideas, but from our space and from our perspective, the financial technology space is one we're playing a lot in. The budget tool that we're literally piloting right now is an aggregation tool where it aggregates all of your spend across any of the places. I don't care where you're spending, subscriptions, monthly spend. It tells you what you're doing, so at least you have evidence and you can see, okay, oh wow, I didn't realize I still was paying, you know, that that monthly fee for that same kind of music services. I didn't realize I was doing these things. So the aggregation of all your budget into one place, and then the AI stuff, which I'm laughing as well, the AI technology that starts to say like, hey, I see these trends. Here's some things that you might want to do differently. And then you're not only showing that, but you're giving some advice at the same time, right? And you have the AI opportunity, but then you have the opportunity, if this is not helping, you can actually talk to a banker. So I think that's a tool too. For us also, in terms of the savings, which we're really anchored on too, in terms of auto save, but now you get into, we have an auto save feature where you can save it from any place where you don't see it. It just takes money and it pulls it in on a daily basis even. You can save $1 a day even, or you can save $2 a week. So you can kind of do that, but you can specifically say, I am saving for X. So now having tools to say, I want to save for education, I want to save for school, rainy day fund. So having that ability to see that all in your mobile app is critical. And then last but not least, how do we get to our youth, which I was hoping we'd have this conversation. And when you think about what's happening today, we have a keen focus on the youth, not only just in a product that we're playing around with, a product for the youth, but also the education of the youth. And how do we get them educated, but also give them some products at a very young age? Because as we know, I watched my 11-year-old nephew teaching my 100-year-old grandmother how to use technology, and literally. So at that point, they're sucking in the information. So why not give them some financial service tools, let them start banking at a younger age? So when they get to that point, you don't have the same challenges around, I don't know how to budget, I don't know how to save, I don't know how to spend. So we're kind of anchored on that too. I know it's a long-winded answer, but that's kind of how we're thinking about it from kind of A to Z.
Again, amen on that. Reach the youth one. That's awesome. Yeah, absolutely. Oops, you're muted.
I'm good.
You're on mute.
My dog was barking. I was trying to hide. Yeah, Darlene, I wanted to dial into you on that subject too, because I know it's something you mentioned on our pre-chat about, this, I know I grew up without any financial education. I just stumbled through it. I know as an industry, we're more bullish on just simplifying things and as a more promising area. But what do you think from a financial literacy standpoint? Where does it start? What are you looking to?
Sure. There are only 21 states in the country that require personal finance to be taught in school, and even fewer that require some kind of an exam that you have to pass. So we are, I think, doing our youth a disservice in sending them into adulthood without the tools to be able to make very complex financial decisions. And so, at Wells Fargo, we have our Hands-on Banking program, which is a free financial education program. We just launched a new Hands-on Banking for Youth digital learning center that has tons of interactive opportunities for youth to learn, youth from as young as kindergarten, where you're just sort of teaching about needs versus wants and delayed gratification so that they can start to understand the concept of saving for something in the future, all the way up to high school and understanding credit, because they're going to have to make some complex decisions about student loans if they're thinking about going into higher education. So it's definitely so critical that we prepare our youth for their financial futures and really to own their financial futures, so that hopefully we can stop the pipeline of people that are moving into adulthood ill-equipped to actively participate in the economy.
Yeah. And this is a big transition, but it just reminds me of the other things we've been talking about, and that's on the policy front. And you had mentioned also about stimulus checks and how that might open the door for rethinking policy. Let's dial into that a bit more. I mean, what is that opportunity exactly?
Sure. We've talked a lot about, what do you do with people that just lack income? And I think that, for a long time, things like direct cash assistance have met a lot of resistance when we've talked about incorporating that into our social safety net. But we saw the positive impact that the stimulus has had on tens of millions of people, where we didn't have to make people jump through a lot of hoops to gain access to that cash. We didn't put parameters around how they had to spend that cash. So I think, this pandemic is devastating to so many people, health-wise and financial-wise. But I think that this is also an opportunity for us to re-examine and evaluate our policies. And, maybe there is a place for direct cash assistance as a part of our social net safety net so that we can improve the financial stability of vulnerable families and get them on the right track to living a financially healthy life.
So we've presented a lot of ideas here: technology, policy, regulation. I mean, that's a lot. So I know we're running low on time. So I wanted to say, or ask rather, what do you think needs to, and round robin, so pressure's on everybody, but what needs to be in place by the next recession? What would you like? What would be like one or two tangible things you think, yes, this is, let's go, from a bank and credit union perspective to help financial health?
Ken, you want to go first?
I was going to AG.
Go ahead, Gigi.
Okay, sure. We're all looking at each other. You go.
You're first.
So, I think Lawrence hit on it. That statistic that we all cite of, 42, maybe now 39% of us not being able to come up with $400, or 78% of us living paycheck to paycheck. If everybody in this country could have a safety net of some amount, whatever that amount is, if it's 400 or otherwise, but a cushion so that they have slack when life happens, as life has happened to us all over the last 3 months. That's a very small win. And then I would echo what Darlene said. Look at policy and change it. This is the time to change it. And cash assistance, there's proof that it works. Why not? So,
I think if there's the thing that it's very hard to predict what the cause of the next crisis will be, right? I don't think any of us, as we came out of the financial crisis, expected that the next time that the economy would tip from expansion to recession, it would be triggered by a global health pandemic. So I think it's difficult to know what solution will prevent the next downturn or people from suffering. But I think what we need is a better response engine. With the technology that we have made available in the banking system to the country, whether that's the card payment networks or the real-time payment system now or otherwise, you would think that there would be a more efficient way than mailing paper checks out or utilizing a loan guarantee engine that, the SBA is to be commended for what they managed to accomplish, because they underwrote something on the order of 20 times the volume in 1/6 the amount of time that they're accustomed to doing. So I would like to see the partnership between the federal government and the state governments and the banking system in crafting response engines that allow us to get money into the hands of people who need it much faster, leveraging modern technology and not the check printing press.
I would. Oh, sorry. I would echo the comments of my fellow panelists, and then I'd like to also see changed narratives. To Gigi's point, having empathy for the struggles that people do face from a root cause perspective. I'd love to see banks really adding a racial equity lens to our work, whether it's in terms of how we're developing products and services or our philanthropic investments. And I'd love to see the birth of new types of fintechs that focus on removing systemic barriers to good financial health and maybe take friction out of the system.
Yeah, and I'll go last but not least. To put a bow, I agree with absolutely everything. The way I'm thinking about it is just to put a bow on what you guys said, which is we need a cohesive strategy, a coherent strategy, quite frankly, that includes our government, but also includes fintech companies, banks, and the communities. And if we don't have that cohesive, coherent strategy in place that's already running, it's just going to be too late. We'll have these same conversations again, but that strategy involves all of us. As I said, this is a community and a family. It has to be cohesive, has to be coherent, and we have to all buy into it. And all the things you said are in play. Education, financial literacy, savings is a big anchor, whether it's saving $400 or whether it's, a different lot in life where you need to have 6 months of savings for something else. It just depends on where you are. But all those things from my perspective are critical, or otherwise we'll be having these same conversations. But I am optimistic right now that I see change and I feel change, and I hope you do too.
One thing I have noticed from different apps, different personal finance apps, different fintech apps is like even the savings goals have changed. Of course, less traveling, so it's more about like, oh, I'm building an emergency. It's like it's a subject of interest, of necessity. So it's interesting to see how that renewed interest might play out. And with that, we're out of time, which is too bad. So I just want to thank the panelists for being here. I know we all kind of are like-minded in what we want to, the end goal here, but it's a very interesting conversation about the different ideas of ways to solve pockets of these pervasive problems. So thank you, everyone.
Thank you.
Thank you.
Thank you.
Welcome to Emerge. My name is Theodora Lau, and I'm the founder of Unconventional Ventures. Now, 2020 did not turn out the way we expected. With a tsunami of mega deals being announced in the first few weeks of the year, many thought it would yet be another banner year for fintech funding and M&A activities. Then came the pandemic, and the economy came crashing down like Jenga blocks. With jobless claims hitting unprecedented levels, what do consumers need the most, and how will financial services react? What roles do fintechs play in this new world, and how can we, as an industry, be more purposeful in what we do? In the next 40 minutes, we'll consider the trajectory of fintech, its capabilities and limitations, and the role in the future of financial health. So now let's introduce the panelists. We have Andre Cherney from Aspiration.
Hi, glad to be here.
And we have Emmeline Shaw from Flourish Ventures.
Pleasure to be here.
And we have Annie Lim from Honeybee Financial Wellness.
Thanks for having me.
And last but not least, we have Hans Morris from Nika Partners.
Great, nice to be with all of you.
It's wonderful to have you all here. Now, the financial crisis and the health crisis, if you will, has laid bare the structural inequalities that we face in the society, especially for those that are poor, the ones that are non-white, women, and gig workers. Now, while some people might be celebrating that, oh, yay, the national unemployment rate has actually fallen the last month, if we dig a little deeper, Asians and African Americans actually saw their rates increase from April to May. And overall, let's be honest, unemployment is still at quite historic levels. And so unsurprisingly, Annie, I think last time we talked, a lot of the people that are in line at a food bank had actually never been in a food line in their entire lives, according to Feeding America. So let's start with you and Andre. What are some of the most pressing needs of your customer base at this point? And has your work changed in the last few months to meet those needs?
Yeah, so we work directly with employers. And like you said, over the last few months, we've seen how it's impacted employers, employees, and their families. And we've been speaking to employers where they had to unfortunately reduce workforce hours, workforce pay, and furlough and or lay off part of their staff. And employers were starting to tap into their retirement savings. And so getting access to cash was and still is a pressing need for employees nationwide. You mentioned food banks. We actually work really closely with the nonprofit sector and especially food banks. And like you mentioned, we saw a huge spike in demand with their services. And although there were no layoffs with food banks, 1 out of 5 households were still losing income. And that was causing a lot of financial stress for employees. And part of what we did is we ensured that not only just employees, but families had access to our on-demand financial counseling services. So we help employees and their families that were laid off navigate through the unemployment application process. keep them up to date with information, whether it's freezing rent, consolidating, or refinancing their student loans. And just to briefly touch on the structural inequalities that you mentioned. So we provide access to our 0% interest loans regardless of their credit. And we've been working closely with Washington University over the last year, thankfully through the Financial Health Network. And our data indicates that 88% of the people that utilizes our program happen to be people of color, women, or both. So being able to provide equal access, we're able to have the opportunity to be part of employers' diversity and inclusion initiatives. And when employers acknowledge that there are systemic barriers to financial health and actually provide solutions where their employees can get access to credit, more people of color and women within the workforce can feel more included. And it's an opportunity to really have new perspective, open up new discussions about equality, which is all part of creating a diversified and inclusive workforce.
Thank you, Annie. What about you, Andre?
Yeah, I think for Aspiration, it's really been a chance to think about who we are, what we're doing, why we're doing it, and really an opportunity to redouble those efforts in a fundamental way. Aspiration, we think of ourselves as a financial institution with a conscience. We're really focused on bringing to everyday Americans financial products that help them both do well and do good financially. And we've seen, I think, over the past 3 months, an increased need for both aspects of that, both that do well aspect for all of the kinds of economic challenges that we know and that you referenced, Theodora, but also the do well, also the do good aspect as well, in the sense that people are having a moment where they're really thinking about what's important to them and what kind of world they want to live in, and the enormous challenges we've faced and what we've gone through as a country over the course of 2020, whether it's the public health challenges and the 120,000 plus Americans who've died, whether it's the economic challenges, whether it's everything we've seen surrounding the protests against racism and what that has brought to the fore for so many Americans. And for Aspiration, I believe what we've really thought to do is how do we do even more in this moment? We've seen for us, our customers actually leaning into the Aspiration experience. While, of course, there's been so many challenges around consumer spending, at Aspiration, June will be the 4th record month in a row in terms of the amount that our customers have been spending with Aspiration and our debit card. We launched a couple of programs in early April, right in the midst of COVID and when things were hopefully at their peak, though maybe that's too soon to say, but certainly in a dire moment. And one was something called Aspiration Plus. There was a offer that had a monthly subscription fee with a number of benefits, including something called Planet Protection that makes all your driving carbon neutral, and something else called Plant Your Change, which rounds up each one of our customers who sign up for it, each one of their transactions to the nearest dollar, and uses that to fund planting a tree with every purchase. And we did that with some trepidation, of course. Was it the right thing to do? Was it tone deaf to ask people to pay more in a monthly subscription fee, or to round up each one of their purchases and spend a few extra cents to make sure that they're able to plant a tree with every purchase? But decided actually this is a moment where we had to step forward and realize that part of why we're in this challenge as a nation, whether it is because of COVID or whether it is because of the kind of challenges we've seen around the Black Lives Matter movement, is because there's been these unmet needs, and we as a society have not reacted in a big enough and bold enough way to issues that had been simmering, whether it's something like reacting to the pandemic or whether it's something reacting to issues of racism in our society. And that for something like what Aspiration does around climate change, this was a chance to really do more. And we've seen customers react in ways that were much bigger than I would have ever expected. almost half of our customers now signed up for one or both of those in just a matter of weeks. And I think that speaks to this trend that we've seen over the past few months, which is really people thinking about sustainability, people thinking about conscience, people thinking about values in the midst of all these economic challenges, not more, not less in the way that some people would have predicted, but in fact, even more.
I would agree. I think if anything, this is not the time to back off the paddles, but more so is to keep going forward. I think it's important. We cannot buy the time back, unfortunately. So let's switch over to our two VCs, Ammon and Hans. How are some of your portfolio companies addressing some of these challenges that we've been seeing the last few months? Let's start with you, Em.
Great, thanks. As you know, we focus on advancing financial health and economic resilience. That's the premise of our and thesis of our fund globally. And our premise is thinking about, can we increase access? Can we improve services at the lowest cost for consumers? So given that our direct-to-consumer portfolio is very much built on mobile first, very much taking advantage of where we are today, particularly in a COVID environment. But we've always prioritized the consumer's pain point. That's been a very important part of our value prop in determining what financial services make sense in advancing financial health. And maybe I'll just share a couple of examples across our global portfolio. We have about 9 challenger banks, 2 of which in the US, including Aspiration and Chime. And at the base level, just there was a fundamental need for free checking and savings, something with transparency and trust built into the system, and the ability to really to leverage your banking relationship with a challenger bank in order to get additional services that advance financial health. I think we've had this across a number of different globally, and so as a result, different models, business models emerge, but by and large, that need was pretty pronounced. If you look at America, we've got gig workers, of which there are many, all looking to build a portfolio of work. Some are looking to augment work. And Steady's building a portfolio of hourly work by region, optimizing by employer. And again, pre-COVID, that was very important in terms of thinking about how do you improve and increase your income in a time in which income is quite stagnant, where fixed costs are increasing rapidly. But if you think about the COVID environment, you have folks who are not traditionally gig workers now flocking to the site and flocking to the application in order to augment their income. In markets like Bangladesh, where there's 450,000 SMEs on a Facebook first platform, of which 80% are occurring online through the SMEs, we backed a company called ShopUp, and they're providing an integrated storefront to manage online storefronts for consumers. So that's logistics, that's inventory, and that includes lending against working capital. And finally, I'd point to another point, thinking about Asia and Africa. We've got a company called Pula who provides germination insurance specifically for smallholder farmers, right? What happens if rainfall fails to take place? Is there insurance along that dimension? So we've always really thought about what is the pain point of the consumer at SME. And in COVID, these needs only magnify given our focus and given our portfolio.
Hans?
Well, we do several types of fintech, but we only do fintech, and I'd say probably 20 or 25 companies are doing something related to helping consumers and small businesses. So that includes lending businesses like Lending Club and Affirm, and a company like Nova, which enables immigrants to get access to credit through APIs to foreign credit bureaus. So there's lots of companies that are doing, we think, providing access to credit, or facilitating access to credit. But I think I'm going to highlight a couple of companies. One, because it's very specifically reacted to COVID in a I think innovative and effective way. One is Propel, and they enable people primarily who are on the SNAP program, food stamps, to make better use to efficiently access and see and optimize the benefits that they're entitled to. And they're now up to 4.8 million users, monthly active users, and that's not necessarily good. I mean, that's partly a reflection of more people needing access to the SNAP program. But they've really, I think, created some very innovative products, one of which is they called it Project 100, and they raised $80 million in donations and distributed $80 million to 80,000 people, deserving people on food stamps. And as it turns out, that's the largest private cash transfer in history. And so you're frankly just appealing. These people need money, and they target it. And so you know your money is very efficiently, like there's no service fees or anything. It's just going directly to people that need help. And something Andre, and I think everyone has said this, that there is it's a very emotional moment for everyone. The people who are affected are obviously going through a lot of emotional anguish, and whether that's economic or physical health. But then I think many Americans have also reacted, and people around the world reacted, saying that they're very empathetic, and the fact that you have a dialogue about race taking place in the United States that's very intense, actually, and it's engaged everyone. It's, I think, made some people respond quite effectively. So I think Propel took advantage of that in a way that really helped their customers. Another one which I think is interesting is Savvy, which helps people who are entitled to education benefits. So there's deferments and forgiveness programs which affect about 14 million Americans are eligible for these, and yet many people who are eligible don't sign up because it's a big pain in the neck, or they sign up and then they don't refile. And so they're like the TurboTax for that. And I think return on education and how to optimize your education, how to make that less expensive, and also make the most sense of what the return should be for individuals is a big issue for this country and for many people. And I think they've done a great job, and they've had huge increase in signups. Again, maybe not necessarily good, it's not a good development, but the fact that they've got an effective solution is a good development.
I agree. And I'm a big fan of Jimmy too. I read about the Project 100, and that's awesome. We need more initiatives like that, like you say, that directly helps the consumers put money in their pocket. Now, looking back a little bit, it's been 12 years since the last financial crisis, which, has given birth to a lot of great fintechs, new business models, new ways of doing things. It's given rise to share economy, for example. What have we learned about what worked and what didn't work? And I'm just going to ask you guys one quick question. Do you think fintechs have done a good job in improving consumer financial well-being? Andre, why don't you go first?
I say this as a fintech co-founder and CEO, which is
absolutely not biased.
Well, not biased in the sense that my answer is no. I think that the promise of fintech has been unfulfilled to this point. That the proof is in the pudding when you look at the economic challenges still facing so many Americans. I think the promise is still there, but I'd say that a lot of the efforts have been maybe nibbling around the edges, maybe thinking that the solution is going to be first and foremost around technology and about digitization of the same kinds of offerings and solutions and approaches that were existing in an offline world. And the thing about fintech is there's nothing inherently unique about that. Fin has always been tech. Western Union was the fintech of its time of thinking about transmitting money through the telegraph. And you go through any time period, ATMs, whatever else may have come along. I think the opportunity was to and is to think about how do you break away from legacy ways of doing business and fundamentally think about different business models, different structures, doing the things that the incumbents can't do. And there's been a lot of progress there, but just when you look at what's happening to so many Americans, I think we still have a long, long way to go.
What do you think?
I think in the wake of this pandemic, it's pretty evident that financial insecurity, it's happening all over the nation, and the government is really not addressing it in a sustainable and responsible way. But to Andre's point, I do feel a lot more can be done. But in order to address these financial insecurity, provide financial inclusion, I think that the public and private sector need to collaborate their efforts together in order to address all of these issues. Like Hans was saying, with Propel, they've done an amazing job during this pandemic. It's unfortunate that so many people had to sign up, but I also do feel like FinTech has done a great job in improving consumer well-being. So we saw it during these challenging times. Companies like Lendio, Square, Cabbage were able to help disperse PPP loans. But still a lot more can be done, I believe.
Do you agree?
Yeah, I mean, look, I think this is an interesting time. I think since the last recession, there's been, you're right, quite a bit of innovation, right? We had Credit Karma coming out, you had Square, WhatsApp, Venmo all in 2008. There's been a lot. And I think in terms of innovation, alternative lending, you got digital payments, you have, distributed ledger, and then you've challenger banks as big pushes over the last 10 years. In my mind, I agree with Andre in terms of there's a lot more to go, but I would say of those massive innovations, challenger banks in particular have been probably the greatest, made the greatest strides towards advancing that. And I say it not because, again, that it's providing basic free checking and savings. I think that's kind of part and parcel table stakes. It's really what they've provided as a result of engaging with that consumer. So once you build in the trust, have cash flow data, and then you're able to look at whether or not there's overdraft fee protection, whether there's a wage advance, and can you build credit, and can you think about innovative credit building products? And then comes budgeting and savings nudges. And I think those in aggregate become meaningful. If you look at some of the platforms globally, they've all been able to showcase increased savings rates from consumers on those platforms. So that's the starting point. Now, we're an impact. We're a fund that's based on a systems change. And I think Andre shares that perspective. And so that's not enough, right? We want them to be successful. But what it really needs to do is inspire incumbents to say, wow, we need to really review our predatory actions and our own pricing. And how do we shift those to really benefit the consumer? And I think only then at scale do you actually see really the consumer at large benefiting from financial health through practices that are really broadly developed. So that would be my point. I think in terms of what else has worked, this idea of trust needs to be rebuilt. I think since the last recession, trust was destroyed. And so fintechs have an opportunity to really build that. And it starts with clear transparency. It starts with the ability, like Andre's company, to be able to provide consumers the ability to actually expend and invest in like-minded companies that are aligned in value. And I think most importantly, the business models have to be aligned with consumer outcomes, right? So that's what I think has worked and will continue to work. What hasn't worked, and particularly pronounced now, is our infrastructure. I think we're about good 10 years behind, roughly, I think, in the US. And today, the US did a great job rushing on the stimulus side to respond, and that was wonderful. The problem is the execution was pretty poor. And it's because we've got a really outdated systems. And so we saw that on the consumer side with the $1,200 of stimulus that took over a month to weeks for a hard copy check. We're in digital era here, we're getting a check. On the unemployment insurance, it's taking up to 30 days state by state. Everything from onboarding to application process to distribution, backlogged. And it's really because of the systems. I mean, we're still working on COBOL when it comes to state and federal systems. And we've got folks trying to Band-Aid the system in order to actually distribute the needed capital. So if anything, that's where we need to really think about massive rehaul and infrastructure. And I'd love to see that come out of this clear call to action.
I agree. This is probably not the best time to bring up the fact that I have to write myself a personal check to deposit in my other account. That's the only way I can move money. But I was thankful, at least I can take a picture of the check so I don't have to go to the branch. Silver lining. Hans, you have quite a few companies in your portfolio. So let's build on that topic of trust that Em was just talking about, because that's one question that we always talk about. How can challenger banks go about building trust and growing that relationship so they can get out of just being, that other bank that you go put a little bit of money to play with? Instead, they can gain and have the primary relationship with the customers, especially with gig workers. How do they go about doing that?
Well, I think trust, in many ways, the financial crisis enabled, I think the financial crisis combined with the expectations of consumers on the type of tech experience they expect created a trust opportunity that many fintechs did seize. So if you go back, I mean, I would say 20 years ago, I'd say who in their right mind would have given some application like your bank login credentials? No one would, and yet there's hundreds of apps that do just that, and people sign up for it. So to me, that has incorporated that's a very strong indication that people do trust these apps. There also was a real abrogation of trust with financial institutions and primarily banks. And I in some ways, I'm empathetic to the banks. They had certainly they made a lot of stupid decisions. Some of them did. But they were just, they had to respond to this massive re-regulation cycle, due to problems that they helped cause. So I'm not defending them, but they also, they persisted then with fee arrangements that made no sense, had no lot. They did that because they financially had to. They were fighting for survival. They shut down lots of their own innovation and cut out projects that made it so that all kinds of things were painful and difficult. And so I think they abrogated quite a bit of trust, which many fintechs seized. And I think that it's interesting that when you look at companies like Acorns or Digit or many of the challenger banks, they have really good relationships. People are proud of that. They like the brand identity that carries. Chime, I think, has done a terrific job in that. Aspiration has done a very good job on that. There's an emotional connection that people have established with these apps. Right now, I'd say the banks, which had a terrible financial crisis, are having a pretty good COVID crisis. And I think they're very aware of this issue and very aware of the duty that they have and the public role that they play to not make some of those same mistakes. And they're forbearing a lot. They're facilitating all kinds of money movements. You look at who got deposits in the first quarter. So JP Morgan grew its deposit base by $200 billion in the first quarter. So a lot of money is going to those institutions, Bank of America and JP Morgan and Citi, and because they are trusted in this crisis, I think, more than they were in the last crisis. So I think, summarized, I think many fintechs have very strong branded relationships with their customers. And I think that, but I feel the banks have actually done a much better job so far in this crisis than they did last one.
Yeah, I like the part you talk about the emotional connection. I think we do see that with some of the challenger banks that stand out. There is a really strong emotional connections between what their value prop is, what they're trying to do, what they stand for, right? And in terms of a purpose to the clients that they serve. I think the next 12, 18 months is going to be really telling. Now, as some parts of the economy try to reopen, I need to say that cautiously, but at the same time, as some of the payment holidays, the unemployment benefits are ending, many people predict that millions of Americans will start falling off the income cliff. There's only so long that you can hold off the eviction, hold off paying mortgages and all of that. I want to look a little bit at that, and at the same time looking at what we have been talking about for the last 15 minutes on how the fintechs have been rising to the challenge and helping consumers in various ways. What are the areas then now fintechs will need to focus on to get consumers back on track, to get them back on their feet for the next few years? What are the plans? What would you be focusing on? Let's start with you, Annie.
Well, I think Americans were already in financial distress pre-COVID. And even though, like you say, the economy is loosely reopening up, people need access to credit now more than ever. So I believe the current credit score system has creates a huge disadvantage for the hardest hit communities. Fintech companies can address these inequities, especially for people of color, by using other data points in order to determine a borrower's ability to repay. We've been able to mitigate our risk by using other factors like wages or tenure. And just in the last 4 years, the average user is they earn about $40,000 to $50,000 a year. Average FICO score is about 540, and our default has been less than 2%. So it's factors that we know it's possible, and we don't have to underwrite based on credit. So there's a potential for fintech companies to make an enormous difference in reducing these economic barriers to allow people of color to gain full access to the financial services that's provided today.
Thank you. And what about you, Hans? What would you advise the fintechs in your portfolio to be focusing on? What do you tell them?
I think and I think this has been greatly affected by COVID. There's 3 areas in particular that are very, very important areas of investment, and I don't think consumers have good tools to manage it. And those are financing your education and what is the best ROI for you. And I think COVID has demonstrated that you can, for certain kinds of education, I think online education is probably demonstrated its efficacy. Particularly for certain skills acquisition. And so not only how you should finance it, but what you should finance and what are those choices and what is your ROI. I think similar issue on childcare. Childcare is complicated. It's a very big area of spend, and it's a big financial decision, and you should finance that too, for many people. In other words, instead of leaving the workforce and taking care of your child because it's expensive, what are there better tools to finance that, and what is the best system to do that, and what's your ROI? And last is medical expenses. There's a problem with the United States in general, which is we have way too much reliance on individuals need to navigate this very complex set of choices, but then almost inevitably there is going to be a significant out-of-pocket expense for many Americans, and how should you finance that or save for that or optimize that spend? I at least feel that the tools for all 3 of those very significant areas are inadequate.
I absolutely agree. And I think I'll add one to financial longevity as well, right? As people are starting to withdraw money from retirement accounts, what's the long-term impact of that? Where a lot of people actually didn't even have a nest to begin with. I think it's going to be challenging times for a lot of people. And Em, what would you advise your portfolio companies to do?
Yeah, look, I think that, so we focus in the US on the 70% of US Americans who live paycheck to paycheck, right? For whom $500 does not exist for an emergency should it arise. And so against that backdrop, and in light of COVID, that population has only increased. And when we think about forbearance, we think about the stimulus efforts, all of which will come to an end, you're right. And when it does, there's going to be massive implications. And we're already at north of 14 trillion of debt in the US, consumer debt. And that's primarily driven, and higher than that, it's a Great Depression, primarily driven by the increase in mortgage debt in particular. But as you think about what are the consumers going to need the most in the short term and probably through the next year as they're trying to restabilize, it's really around debt management. And that's an area that we've spent a lot of time building a portfolio around, whether that includes, managing your home mortgage through EarnUp and others, which allow for payment, setting aside amount of payment so that you can pay it on time with the help of loan servicers, whether that's in the form of student loan debt. How do you think about giving the best optimal student loan options through summer, and really getting them into income-based repayment plans, which are really fundamentally aligned with the income flows, the cash flows of that individual, or even just unsecured credit overall with companies like Clerky and others, all of whom looking for creating debt settlement, debt management tools for consumers. I think that's going to be absolutely critical in this day. And whether it's individuals or whether you add on to your pre-existing offerings, I think it's going to be important for fintech platforms. And then I think also just obviously the real-time budgeting and the savings nudges and creative ways in which you can automate cash flow is going to be very important for consumers as we go through improving resilience. And again, I think this is where fintechs need to really prioritize if they want to help be part of the advancement of financial health, particularly in the US and globally for that matter.
Yep, I agree. And Andre, what about you guys? What are your plans for the next few years?
I think that it really goes back to what Em was speaking about and Hans was speaking about, which is really how do we capture this moment? And so much of it comes down to trust. There's all kinds of things that Aspiration offers to its customers that are just, without question, much, much better than what they're getting from incumbents. And that's true across the board in so many of the fintechs that everybody on this panel has been mentioning and talking about. There's so much innovation happening that would, as it's being increasingly adopted, make a bigger and bigger impact on people's lives. But trust is the door to that. And the financial industry has done better in some ways this time around than it did 12 years ago. But that doesn't change the fundamentals of it. The distrust that was built up over the past number of years towards the incumbents in the space didn't just appear because of their actions around 2007, 2008, 2009. It came because of a fundamental misalignment of interests between institutions that were doing better and better the worse that their customers were doing. They were making money on overdraft fees and late fees and had that as their core economic profitability proposition. And then we're misaligned around values. And for fintechs to be able to really meet the scale of the opportunity, we have to continue to think about trust. We have to be able to not just offer great products, great services, great features, but think about what it is going to take Americans to feel ready to adopt them and to know that they have a financial institution or financial institutions that are truly on their side.
Thank you. I cannot agree more, but you already know that. I'm a big fan. So before we wrap up, I want to ask you all a question. To deliver on that promise, right? That is there, but is yet unfulfilled to a large degree. And knowing what we know right now, what has worked, what hasn't worked, and the state of the economy and the needs of the consumers and all of that combined together. What do you think will be the best way for us to deliver against that promise? Do we see there will be more consolidation in the space? Do we see we'll need more partnerships between the incumbents and the startups, or between big techs and fintechs? What do you think? I do like the point earlier. I think, Annie, you mentioned that we need more public and private collaboration, right? The problems and the challenges are so vast that not one entity alone can figure it out. So, what do you think, Em?
Yeah, I mean, look, I do think that just to answer your question with respect to the activity level, whether it be partnerships and M&A, this is unprecedented going into COVID, and that will continue, right? You've seen everything from the Plaid visas and MasterCard and Vicinity, and you've got Credit Karma, you name it. And I think on the partnership side, we're seeing these large banks, Goldman and Amazon, and you've got Google, and just trying to really actively become part of the fintech ecosystem. And I think that's going to absolutely continue. They're going to be very opportunistic. They're going to, in fact, a number of the large companies with large balance sheets are looking quite actively about how they can extend their reach through some of the dislocated startups, et cetera. And so I think there is a push broadly to continue seeking those partnerships, both on the incumbent side, but as well as on the fintech side of the house. I think, and I agree with Annie, I think at the end of the day, we need public and private to come together in a meaningful and thoughtful way. 10% of our capital in our fund is actually dedicated towards engaging in stakeholders, engaging in regulators and policymakers, helping them convene, helping them think about technology, fintech, how to regulate it differently. I think it's going to be, and as I mentioned on the federal and state side, the infrastructure alone is fundamentally and woefully antiquated. So there's going to be a number of pieces, both overhaul of their own systems, but also a willingness to really reach across and integrate and discuss more actively with fintechs how they can be part of the solution to advance financial health. And you're seeing a lot of that. So let's be clear, it's not like it's not happening, and I think this has been a great important forcing function within COVID to do that more actively. So I'm quite hopeful that that will continue.
Has been a moment of reckoning. Absolutely. So thank you so much, everyone, for joining us, and thank you for a wonderful discussion.
Thank you.
Thank you so much. Really appreciate it.
Hi, I'm Jennifer Tescher, founder and CEO of the Financial Health Network. I often hear people say that our world is more connected than ever, but I'm not so sure. Over the last several months, I've been struck by just how fractured and fragmented our lives are. When tragedy strikes, when chaos erupts, rather than coming together, we isolate. We disconnect. We retreat and cling to the familiar. It's human nature to sort and separate things, to put them in silos, even people. It's how our brains make sense of a complex world. But just because it's human nature doesn't mean we have to accept it. In a highly interconnected world, siloed thinking is not merely limiting or ineffective, it's dangerous. Consider our response to the pandemic. Once the stay-at-home orders were handed down and consumer spending cratered and businesses began laying people off, our siloed thinking prevented us from asking essential questions. We had never thought to ask, what happens when people who are laid off of work lose their health insurance in the midst of a pandemic, no less? When essential businesses told their nurses and sanitation workers and grocery store clerks to keep coming to work, no one had thought to ask, how will we safely transport those workers who rely on public transit? And with schools and daycare centers closed, how will those essential workers find someone to watch their children? And when colleges and universities closed their campuses and sent students home, no one thought to ask, what about the students who don't have a home to return to? Instead, we were constantly caught flat-footed and 2 steps behind, in large part because we failed to see the connections. We also never considered that Black people might be far more likely to die from COVID-19, just like they are more likely to die at the hands of police. It took hundreds of thousands of people flooding the streets in cities around the world for us to finally ask, what are the systemic issues that we need to address to ensure that we value and protect Black lives? We do ourselves and those we serve a disservice when we shove people into categories: worker, renter, patient, students. We fail to notice that your renter is my patient and your patient is also a student. Our silos have hampered our response to the pandemic, and our silos have created centuries of racial discrimination, poverty, mass incarceration, and growing income inequality. If we leave these silos standing, they will keep us from seeing and understanding one another, and we will continue to endure the same difficulties. Just like the silos that store grain or the silos that house missiles, the silos of the mind are also human-made, and that means they can be torn down, which is what we must do if we're going to improve financial health and well-being for all. To get out of our silos and to see people for who they really are, we need to practice taking off our blinders. Take a moment to think of someone who has been important in your life, maybe one of your parents or grandparents.
let yourself actually picture them. Then imagine someone was to ask, "Who's your father?" Or, "Tell me about your grandmother." Would you describe them only by what they do for a living? Or only by where they live? Or only by their medical condition? Or only by where they went to school? When I do this exercise, I think about my grandpa, Larry Smilin. I lived a few doors down from my grandparents when I was growing up in Miami, and I smile every time I think about all of the fun things my grandpa and I used to do together. Back in the 1950s and 60s, before I came on the scene, Grandpa Larry was a traveling shoe salesman, a rep for Stetson Shoe Company. Every few weeks, Larry would get in his teal blue station wagon, turn on his CB radio, and head for shoe stores in cities and towns across his 7-state territory. He always had a sign in one of the rear car windows that said "samples only," so no one would break in to steal the big black cases in the back of the wagon, which were only filled with left shoes. That's all his customers saw, Salesman Larry. My grandpa never went to college. He served in World War II, and the GI Bill enabled him to purchase a house and access federal loans to pay for my mother's college tuition. But he also had serious health issues. An emergency appendectomy kept him stateside during the war. Then, after he got out of the Army and went to work for Stetson, he tore his meniscus, which back then meant major surgery and a year of recovery. That's when my grandma Sylvia went to work. My grandpa eventually got back on the road, but it turned out that he had inherited his father's heart problems. He had his first heart attack in his 40s, and then another, which led to open heart surgery. By that point, his days of traveling the Southeast selling shoes were over. My grandmother became the breadwinner, working as a department store sales clerk. Larry kept house and later spent a lot of time riding bikes and playing jacks with me. Financial shocks like the one my grandpa experienced when he couldn't work, and like the ones we are all facing now as a result of the pandemic, are contagious. They don't respect silos. While the need for work, shelter, healthcare, and education may appear distinct, they are deeply interconnected. And despite all of the data and technology and analytical tools at our disposal, our silos blind us to these interconnections. The result is a two-dimensional understanding of the people we serve. And that means we're not serving them well at all. Now, I too have fallen victim to a two-dimensional mindset. When I started the Financial Health Network 16 years ago, it was originally called the Center for Financial Services Innovation, and this conference was called the Underbanked Financial Services Forum. We talked about the banked and the underbanked and the unbanked. We essentially defined and categorized people by whether or not they had a bank account, and that narrow thinking led us to focus on a narrow question. How can we get people banked? Now, we've all been on the receiving end of a two-dimensional experience. I think about a hip injury I had a few years ago and the experience I had with an orthopedic surgeon. All he seemed to care about was my x-rays and whether they indicated the need for surgery. When they didn't, he shuffled me off to his assistant, who handed me a brochure for physical therapy. The surgeon just wasn't interested in my non-surgical needs. This kind of siloed thinking isn't limited to healthcare. When you work in human services, everyone tends to look like an employee. And when you're a landlord, everyone looks like a tenant. When all you have is a hammer, as the saying goes, everything looks like a nail. In our quest for efficiency and scale, we have focused too much on ourselves and not enough on the people we serve. If we want to tear down the silos and remove our blinders, we have to start by seeing people in 3 dimensions. That means seeing all of the facets of your customer's life: worker, renter, patient, student, in order to understand their true needs and find better ways to fulfill them. It's about listening, paying attention, hearing the context and nuance of people's lives. That nuance isn't merely nice, it's necessary. It's the raw material that we need to build businesses and programs and policies that solve real problems. At the Financial Health Network, the raw material from our financial diaries research, coupled with what we learned from the 2008 financial crisis, have helped us learn to see people in 3 dimensions, to take off our blinders and discover the essential question that we had not been asking. How can we improve financial health? Instead of bank accounts, we began thinking about what people were telling us they really wanted: to be resilient when times were tough, and to seize opportunities when times were good. Considering the whole person as worker and renter and patient and student helped us to think beyond our self-imposed boundaries. The word for seeing the world through someone else's eyes is empathy. Too often, we let marketing messages substitute for empathy, but the customer sees right through it every time. Consider the Cleveland Clinic, whose story was documented in the book, The Silo Effect. The hospital was riding high at the turn of the 21st century. It was one of the biggest medical centers in America, with a $6 billion budget and a staff of over 40,000, and many of its specialties were top-ranked. Against this backdrop, in 2004, the hospital appointed a new CEO, Toby Cosgrove, one of the most famous heart surgeons in the world. Cosgrove was cut from the same cloth as most highly successful surgeons, ambitious and sure of himself. So he was taken aback when, during a lecture he was giving at Harvard Business School, one student stood up and told him that her father recently sought heart surgery at a different hospital because the Cleveland Clinic, while more highly ranked, lacked empathy. Now, empathy wasn't really part of Cosgrove's lexicon, and at first he dismissed her comments, but they stuck with him and gnawed at him. And ultimately, he found himself thinking about the hospital from the perspective of his patients. Once he did that, he realized that the hospital was stuck in the wrong silos. It was organized into departments based on medical specialties, and surgery and medicine were 2 completely separate organizations. But how is a patient experiencing chest pain supposed to know whether she needs surgery or medicine? Over the course of 2 years, he upended decades of cultural and industry norms by reorganizing the hospital around a series of 27 multidisciplinary institutes that focused on ailments like cancer or body parts like the brain, with doctors and surgeons forced to work side by side. As medical professionals stepped out of their silos, amazing things started to happen. In the Orthopedic and Rheumatology Institute, the rheumatologists demonstrated to the orthopedic surgeons that monitoring calcium levels after surgery produced better results. In the Urological and Kidney Institute, the surgeons began working for the first time with the nephrologists to better understand the underlying causes of kidney stones. And together, they were able to develop cheaper, non-surgical treatments. By 2013, the Cleveland Clinic had risen from the bottom of the patient satisfaction rankings to the very top, while continuing to be highly ranked in nearly every specialty. Even more remarkably, the hospital was achieving these results at a lower cost. Let me say it again. Silos are human-made. They are products of human bias, a reflection of our culture, for good and for bad. But as the Cleveland Clinic demonstrates, culture can change, and silos can be dismantled. It's only when we tear down our silos that real innovation happens, even in areas not necessarily known for creativity. Take American Family Insurance, for example, a Fortune 500 insurance company headquartered in Wisconsin. In 2012, the company had purchased The General, which specialized in insuring drivers considered high risk and whose car insurance premiums were typically more expensive. American Family quickly found that while many of The General's customers struggled to pay their premiums on time, they were proactive in trying to structure payment plans. So the company decided to partner with designers from IDEO to see their paycheck-to-paycheck customers in 3D and to understand how they could help. Here's what they discovered. People needed an easy way to earn extra money. Most had full-time jobs, but the income wasn't always enough, or it wasn't consistent. So American Family launched a new subsidiary called Moonrise, a temporary staffing agency for shift work. The company sources and screens its policyholders and matches them with opportunities to earn extra money. Since the launch of Moonrise 2 years ago, the company has expanded to 3 states and has helped customers generate $1 million in additional income. And while it might seem crazy for an insurance company to own a temp agency, both businesses are actually offering a similar value prop: peace of mind. So let me ask you, are you putting the people you serve in silos? Is it serving them? If not, then is it truly serving you? It may be scary to think about pushing yourself out of a silo in the midst of a crisis, but maybe it's the perfect time. Maybe we have no choice. In Chinese, the word crisis is actually 2 words put together: the word danger and the word opportunity. Right now, we have the opportunity to learn from the past and rebuild our systems to be more functional, more humane, more equitable, more integrated. I believe it is not just our opportunity, it's our responsibility. We must see one another with renewed empathy and clearer vision. We need to think anew about the meaning of economic justice and how to make it just for everyone. We can and we must break free of our silos and build an integrated financial health system for all. What if we were to break down the silos of our economy and reorganize around the financial health of the people we serve? For instance, what if you're a bank and some of your customers are out of work? You might create a temporary staffing business to match your out-of-work customers with the businesses in your portfolio that need workers. What if you're a doctor and it turns out that your patient's high blood pressure is actually caused by financial stress? Along with a prescription for blood pressure medication, you might also prescribe financial coaching sessions. And if you're a health insurance company, you could reimburse for the cost of those counseling sessions. What if you're a landlord whose tenants are sometimes late paying their rent because of tight cash flow or frequent emergencies? Well, you might offer an auto savings option to enable tenants to set aside a small portion of each month's rent into an emergency savings account. What if you're a college administrator and you realize that every semester some students come up short on tuition? Well, you might consider sending students a financial health scorecard alongside the end of semester report card. What if you're an employer with a large call center staff and post-pandemic, you expect them to continue working from home? Well, you might consider converting your investment in office space into investments in safe and affordable housing for your workforce. This is the kind of integrated thinking that we need to improve financial health. I mentioned earlier that our annual conference used to be called the Underbanked Financial Services Forum. We chose to rename it 7 years ago now because the companies and organizations we were working with told us that it was no longer helping them make the change in their institutions. Instead, it had actually put their work into a silo and that was making it harder for them to get the broad buy-in and resources that they needed to build products and experiences to help improve financial health. We never could have predicted that the new name we chose, Emerge, would be so apt in the year 2020 as we consider what will emerge from the crises of these times. So much is uncertain these days, but one thing I am certain about is that we need more human engagement, more empathy across sectors and silos. We need to ask more questions and listen compassionately and open-mindedly to the answers. Engaging at an annual conference is great, and I miss being with all of you, but things are happening really fast, and being together only once a year and in any single place is just not enough. And so I'm launching a new podcast, Emerge Everywhere, to engage with leaders, innovators, and policymakers about how they're working to unleash innovation and creativity by seeing the people they serve in 3D. My first episode will air on July 15th. Visit emerge.finhealthnetwork.org. Click on podcast. I promise that I'll be doing more listening than talking. They say that hindsight is 20/20, and that rings especially true right now. Foresight, on the other hand, is not 20/20. It requires peering hard into the future and imagining what it could look like, what it should look like. Building the future takes more work, more energy, more passion, more innovation, and more care. To answer the question of how we can improve financial health for all, we first need to ask two others. What can we do to see people we serve in 3D? And what can we do to serve workers, renters, patients, and students in ways that recognize their common and complex humanity and creativity? Those are the questions. The answers are in the work that lies ahead, and it starts by tearing down the silos.
Well, folks, that's a wrap on 5 days of incredible content around financial health. We hope that you've been able to join us throughout the week. But if you missed a few sessions or want to return to some content that spoke to you, they've been all recorded and will be available live on the Emerge Live site for you to view when you have time. I'd also recommend that you browse our related content throughout the site and visit us over at financialhealthnetwork.org to connect further with us and learn more about the important work we're doing with our members and partners around financial health. I would like to announce that we're also launching our new podcast, Emerge Everywhere, on July 15th. This new podcast, hosted by CEO and President Jennifer Tescher, will feature innovative leaders who are breaking down silos to create an integrated financial health system for all. Thank you to all of our speakers for participating and sharing their time, expertise, and talent to these critical discussions. I also want to thank our sponsors again for supporting us through this shift to a virtual format. We truly appreciate your partnership. I'd also personally like to send a special thank you to the Financial Health Network team and our partners who have worked tirelessly to stand up this vision to bring our financial health conversations to a wider audience while keeping people safe and healthy in our continued social distancing. I'm incredibly proud of all of you. Thank you for your teamwork and your creativity. From all of us at the Financial Health Network, we wish you a very happy end to your week, and thanks again for joining us.